We are ready to go. The running joke is it either rains or snows every time we have this event, and this year was no different, I guess. But thank you all for making the drive down, and it's just so great to be back in person. But we're so excited to have all of our attendees. Yes. Well, we're so excited to have our first hybrid event. We have over 200 attendees online right now viewing our event. So thank you so much. Really excited. I know, and this is our 13th year now. So our National Manufacturing Outlook, and again, very excited. And I know it's so many critical issues that are facing manufacturers today, and we're going to tackle some of those. I know we can't solve them all in 4 hours, but I wish we could. But we're going to tackle a lot of those issues. Before I get into my program, I really want to take a look back. We did a manufacturing survey back in April, May timeframe. We want to take a look at that with you and give you some of the results. We're only going to touch on a handful of activity. So we said, what in the next 6 to 12 months, what do you see as your greatest, your risks, right? And I think every one of us in manufacturing can attest that, rising labor costs, absolutely, right? Rising commodity costs, supply chain disruption, all huge issues, right? And Stephen Lathrop is here. We're going to tackle some of the kind of what's going on with the rising labor costs and the supply chain issues for sure. Right? But let's take a step back just for a second here and think of, what was kind of really driving some of this? Obviously COVID, right? For sure. But I will say, what happens when you put more than $8 trillion into the market? Money supply is up 28+%. You have a lot of money chasing too few goods. That's a big part of it. Now, will that right size? David Sowerby is going to be talking to us about, what's the outlook in economic-wise and inflation. But what I really see is, the other part is, we always wondered, what does it look like if the world stopped? And we had it. COVID hit, and people went home, and people reflected. Do I want to work anymore? Do I want to retire? What am I doing in this state? I want to live in that state. So it changed. It turned into the great resignation, quite frankly. So that'll take time to work out for sure. And which of the following supply chain strategies? Yep. What did we first instinct was, we need to find alternative suppliers. I'm going to look this up on Google and I'm going to find another supplier. And we realized we don't make much stuff here anymore, ironically. We realized how reliant we are on overseas for a lot of our supply, and we're going to talk about that. And what is your business doing to approach Industry 4.0? So why is this important? So the last 4 or 5 years, we've been speaking at our outlooks around Industry 4.0 and the importance for our, what I call our small, medium-sized entities, companies that are under 500 employees. What are we doing in this race? Because what did we realize also when COVID hit was suddenly it was the future. Everything technology. How do I get to our records? How do I exit remotely? And this became a driving factor, and it really separated a lot of companies. A lot of companies became really disabled during this time frame because they weren't able to access records and even work remotely. And I know in obviously manufacturing, we need people on the floor, but record-wise, we struggled. And this is something really new. You've probably been hearing about it. Obviously the new administration, this race for being carbon neutral, and you see the Amazons and the Googles and all these companies saying carbon neutral by 2030, 2035, and this is now trickling down into the larger companies, Fortune 1000, There's only so much they're going to be able to do before they start reaching down into the, what I'll call the tier ones, tier twos of supply chain, whether it's automotive sector or any industrial sector. This is hitting. This is becoming a huge thing. And Stephen's going to touch on this subject of where regulation is going with this and how to really position yourself to take advantage of this opportunity. That's some of the results from our outlook, or from our manufacturing survey. So here we are. What is the roadmap to what lies ahead? We call it the next frontier. And you're probably saying, doesn't really feel like the next frontier in a good way right now. And I get it. We are all it's a very difficult time period, whether you're in automotive and chip shortage or any industry. There's a supply chain mess. We have clients that have plenty of work, but not enough workers, right? And so how do we deal with that? Well, before we get in this next frontier, I have to take you back in time, 30 years, actually, to kind of set the stage of why this is one of the greatest moments, I feel, that we feel, that manufacturing is on the cusp of one of the greatest breakthroughs in the U.S. has ever seen. And you say, what has happened? This chart says it all, quite frankly. Where did all the workers go? We lost a third of our manufacturing jobs from 2000 to 2010, right? And I know this is going to sound like, just bear with me for the next 5 minutes. It's going to sound depressing. It really is. But we did. And we lost it to maybe other industries. Our youth decided to say, hey, I want to work at Google and Apple versus out on a manufacturing company. All kinds of factors came to play. But also globalization. What we called for many years the race to the bottom, right? Every manufacturer is working. We learned about lean and wringing out every cost and just-in-time inventory and everything we could to squeeze every penny out to be competitive. And we did. You did a great job. Productivity, look where it went. Productivity rose, our output. But look at from 2010 to 2020, it's been overall pretty flat, right? I'm not going to get into politics, but our prior administration did recognize what? That we need to rebuild manufacturing here in the U.S. And we need to do that through trade agreements, and we need to do it through taxes and incentives to make the U.S. competitive on a global stage. Then what happened? COVID hits, right? March of 20. We also have a change in administration, January of 20. And probably many of you haven't seen this report. So one of many of Biden's executive orders, 14017, it's a 100-day report. It's 250 pages. You can Google it, you can find it. The first 30 pages are the most enlightening read since I can remember about someone really kind of laying it really out about what happened. And this 100-day report talked about what happened in the supply chain and what do we have to do to be competitive. And it's very interesting. So let me share some of this with you. And what did we learn in this report? Yes, suddenly 50% of our PP&E, right, is manufactured in China, right? We had shortages across what? All of our hospitals. We called up and they asked, we need gloves tomorrow. Let's call up, somebody down the street. We realized what? There isn't anybody down the street. There isn't anybody in our state. There isn't very few in our country. Ventilators. There's one, maybe two manufacturers in the whole United States. Most of those parts came from overseas, right? Then the automotive sector found out what? And these are facts right from this report. Semiconductors dropped from what? 37% to 12%. You say, okay, yes. And really in Taiwan, I will say that there was tremendous amount of subsidies to build that industry. And what happens when you take a sector like that, not only did the volume go, but the R&D, the technology, everything was lost. And then we said, you know what, electric vehicles is the way of the future. Absolutely, okay. Well, guess what? Right now, there's certainly some other battery technology out there, and we know of a few companies that are working on it to reduce the amount of lithium and cobalt, right? Absolutely. But what do we realize? Over 50% of that is manufactured in China. Now, we have this opportunity. I just saw, just the other night, it was just ironic, a YouTube video in Nevada where we produce some lithium. They said we could quadruple production in Nevada, but we can't because of environmental concerns. Because producing in lithium is a very dirty environmental, it's the outcome of the battery EV is very clean, but producing is actually worse than producing an ICE engine. And this is where this says it all, I think. And I had to just put this quote in there. And then we're going to turn this around and get really excited. But a robust and resilient supply chain must include a diverse and we can all agree on that. Absolutely, right? Therefore, we must rebuild our small, medium-sized business manufacturing base, which has borne the brunt of the hollowing out of U.S. manufacturing. And when I read that, I thought back, I've been in this business 25 years, passionate about manufacturing, passionate about our clients, and seeing everything, how hard each one of our clients have worked to be competitive, to say, hey, don't move that overseas. And the only thing I could think of, reading this is that we told you so. We told you so. It's like we watched this movie happen, and then it came to an end, and then we realized that we don't make anything here, not as much as we did, right? So this is really, if there's one thing that COVID did shed light on, is that it put a light on, is that we need to manufacture here back in the USA. And this is an amazing opportunity, I think, because I know we can compete, absolutely. Whether it's through robotics, technology, everything we do, we know we can compete. So where does this new frontier take us? So first off, as we know, is that we have not made huge investment into our skilled labor gap. We really haven't. So will this be the time, and you were starting to see it even in the state of Michigan, we're seeing it in other states, Ohio, all across the Midwest, we're seeing these resurgence of programs for skilled labor. And this is the beginning. Now, this won't be solved overnight, but this is an excellent start to revitalize our skilled labor gap. The next part of this, the Biden, this executive report talked about is reshoring, nearshoring, and friendly shoring, right? So these are the key sectors that this committee thought were most at risk as far as that we need to make major investments. Semiconductors, advanced batteries, critical minerals, materials, and pharmaceuticals. Now you say, well, I'm not going to be a chip manufacturer. No. But, we have Samsung building a $17 billion plant in Texas. I can't remember the other company, but they're building I think it's NIST. They're building a plant in Arizona. Think of all the supply chain that goes under that. Robotics, automation, equipment, tremendous opportunity. We are already seeing opportunities for clients in really some of the medical and the PPE space that's starting to break free. So some will happen fast, some will be slow, but these are happening very, very quickly. And we can talk all day about, obviously the battery and EV revolution that's happening. You can't pick up a paper today in automotive news that, we got $12 billion investment from Ford in Kentucky and Tennessee We have Toyota building a battery plant in Texas. We just saw a JV with Stellantis and LG for a battery plant. We have several battery developments here even happening in Michigan that you're hearing about. So think of all that. There is a lot of suppliers that can benefit from this production, and we're seeing it certainly on the prototype, low volume, lots of opportunities here. In the critical minerals, you say, yeah, I'm not going to be in mining. No, you're not. But you think of all the equipment manufacturers that are going to benefit from this, right? And the pharmaceuticals, you know, I'm not going to get too deep into that, but it was a fact in there that over 80% of our generic pharmaceutical ingredients are manufactured out of this country. Yes, it probably did save us trillions of dollars. It likely did, but at what cost? So in this executive order, what were some of the key recommendations? Yeah, we need to throw some money at the problem, quite frankly, and $50 billion should be allocated to advanced domestic manufacturing. Not only that, they talked about R&D, you know, technology, and the supply chain. So significant opportunity here for manufacturing. Battery development, as we talked, there's a huge investment going to be made. Now, is this transition happening too fast or too slow? I mean, you can argue this all day long. I've had a Tesla for 2.5 years, and I would say it works really good for some, but others will find it inconvenient. So it won't fit everyone. And right now, battery is still, you know, represents about 3% of the market. So you're going to see some huge numbers that batteries are up, you know, thousands of percent. Well, yeah, from not much. But it is a tremendous revolution in automotive. And there's going to be winners and losers. But the ICE engine is still going to be around for quite some time. So let's now just take a look at what we've been hearing about in this infrastructure. And you hear about this Green New Deal and everything that's going on, and it's really everything green, right? You know, that is going to, you know, whether, you know, it was 5 trillion, 3.5 trillion, maybe it's down to 2 trillion. You know, I kind of carved out and looked at it, you know, as best I could. There was about 300 billion. The rest of it, it's going on, I'm not sure, but 300 billion was really for green, green infrastructure. And, you know, again, Stephen Lathrop is going to touch on this because, you know, there is opportunity here. The reason I put this slide up, you know, as being carbon neutral by 2050, it's not to have a really busy slide, but is, you know, you may not be in wind, you may not be in solar, but, you know, we know that the battery EV is an opportunity. Those that are in, buildings, you know, there's going to be a green revolution with that. Heat pumps. There's all kinds of opportunities in this space that is going to multiply, and we see it happening even more so. Some quickly, some slowly, but this is coming to your backyard for sure. And we see, you know, the factory zeros. We see, you know, this is happening. It's definitely coming. And I know there are plenty of risks, and for sure. And, you know, obviously one of them that we're facing is, you know, where does inflation go, right? And hopefully David Sowerby will be able to shed some light on that for sure. But some of it is, I think, is not going away. Wages are not going back down. The skilled labor shortage will likely continue. Will it get a little better? Yes. The hard part about this is that it does really put pressure on the small, medium-sized businesses to compete with some of the larger entities, for sure, for labor. The other item I put on here is that, you know, under this administration, will the government have a heavier hand in determining winners and losers? Could very well be. We don't know. don't know. And then finally, can't, as a CPA, we cannot talk about taxes, right? So, and yes, this is looming. We've seen it, 2.5 trillion, 3.5 trillion. It's kind of, frustrating when you read like that Biden executive order. You read it and you're like, wow, this is great. I mean, we got to reinvest. We got to do all this stuff. We got to, R&D and then you're like, yeah, but we're going to raise taxes $3 trillion. And you're like, we're trying. So it is a, but we are here. This is our job as is to make sure that you keep every dollar in your pocket for sure. It's very, very important that we find that's our job, and we're going to make sure that all the hard money that you've earned, you're going to keep as much as we can through credits, incentives, and tax planning. We will work through it. We will find a way. So how do you begin to think about capitalizing on some of these opportunities, right? So Dan Bruce is here. He's going to talk about strategy, right? And this is probably one of our fastest growing sectors, really in our firm, and because it is a reflection point. You have a lot of things going on. Obviously, in automotive, if you're producing ICE components, yeah, it's not going away tomorrow, but the value of your business is slowly eroding. So how do you transition? Is it into other markets? Is it proprietary products? How do you begin to build that? And you need a process around building that strategy, because at the end of the day, the work is not going to fall in your lap. It's not going to show up on your door. You have to go out and fight, and you got to win it, right? And then finally, these are big picture ideas, talking about building brand. And we're very excited to have Tony Spielberg here today, who's a brand ambassador for his company, right? And the importance of building that brand, but also how do you market? How do you get out and build new relationships in new markets and be able to sell, right? So this is a very important step for your business to find a way to grow. And that's really what we got to do. We got to find a way to grow because wringing out the costs, and it's all important, we got to find a way to grow. And that's really what we're here today to go walk through is to give you some ideas around, strategy, branding, what's going on with the labor markets, and obviously decarbonization, but lots and lots of opportunity that we see is really one of the greatest, pivoting points that we have in America. I think it's exciting time. How fast or how slow it'll happen, we don't know, but it's a very, very exciting time for manufacturing as we look forward into the future. And that is the end of my presentation. I'd like to now welcome up David Sowerby. Needs very little introduction. David has been on CNBC. You've seen him on plenty of news networks, and has been a great ambassador presenting with us for many years. And hopefully he's going to tell us that inflation is going away and everybody's going back to work. Right?
Tom, no slides, just conversation. So, just internally, you have to laugh when somebody says you don't need any introduction. It just means you've been around a long time. I mean, that's just it. So having done this a few years, the pledge is the same. If you can't say your piece in 20 minutes or less, shame on you. And then if there's any questions, that's always the more engaging, fun part. So encourage questions. I guess the punchline, to give it to you straight out, is welcome to the conversation on business, manufacturing with a domestic focus 2.0. I think that's more and more intact on the reopening. Now you could say, okay, in my world, as a portfolio manager, reopening 1.0 was probably just about 12 months ago in early November when Pfizer and Moderna made their vaccine announcement. I think more appropriately for anybody who actually makes something in this country in manufacturing, reopening 1.0 arguably goes back more than 8 years, and a message I've consistently sought to deliver at this event, that there's been this, let's call it manufacturing rebirth. You could even embellish it a little bit more and call it a manufacturing renaissance that's taken place in the U.S. Really, as I said, going back about 8 years. And think about it. It occurred, politics aside, it occurred in the Obama administration. As you think about risks today, whether it's inflation, potentially interest rates, taxes, regulation, they're all coming to cut to the discussion on inflation. The overused transitory term has gone away, and inflation is going to be more problematic. Just how problematic is the key. And then we'll talk a little bit about, at least from my industry's perspective, how ESG is impacting us and how it is indirectly connecting the dots to you. So if you just kind of, too many numbers, I don't want to do that, but just think about 2 years ago today from a business profitability standpoint. We had this conversation just about 2 years ago. You would have been talking about EBITDA margins for U.S. business at 20%. Here we are today. We're in about the top of the second inning for third quarter earnings reports for publicly traded companies. EBITDA margins aren't 20%, they're 21%. Even more important to me is free cash flow. If you've heard me speak before, you know that's probably the most important number I look at when I look at a company's ability to create shareholder value. Free cash flow margins were more like 10%. Today they're more like 12.5%, well above their averages. The S&P 500, for what it was worth, 2 years ago was at a level of 3,000. Today it's at a level of 4,500 and change. We've had a CAGR in 2 years of 25% for the S&P 500 with a 6-week turmoil from February 19th to March 23rd, to be a little too precise, in 2020. And Michigan stocks have fared quite well in that same time period. They've had a CAGR pretty close to 25%. So names like Penske Automotive Group, Shift, which was Spartan Motors, Ally, Domino's, which was the closed economy play, Spartan, the food retailer, just to name a few. And maybe last but not least, 2 years ago, the ISM Manufacturing Index was at 48. Today it's at 61. All those numbers really demonstrate the ability of the economy to have withstood the last 20 months of turmoil in COVID. Now, I'll give you my quick editorial out of COVID. Some of these, what we've learned and lessons is simply this. In March 2020, the Fed had the toolbox because of what they learned in the great financial crisis in 2008. And what they did in 2008 with money growth was child's play compared to what they've done in the last 20 months. Another lesson out of COVID is, like it or not, when you take government support on the downside, particularly starting with the CARES Act and PPP loans, as you know well now, you have to accept government intrusion on the upside, whether it's taxes or the indirect tax on regulation. What you know better than I do is a reassessment of just in time. And really, this 8-year trend of not offshoring, but onshoring of manufacturing. In my world, this 20 months has really reinforced to me the perils of too much CNBC market timing. It just doesn't work. It was about what you owned before you knew the risk of COVID in a portfolio versus could I tell in February of 2020 this was going to be more problematic? And then on March 23rd, did some head lifeguard blow the whistle and say, everybody back in the pool and re-up risk in your portfolios? What it also did was it reset the cycle. I think in baseball terms, because we're in playoffs, we're probably somewhere around bottom of the second or top of the third in this current business cycle. The key will be, does it last as long as some of the more previous cycles, which were really extended? Inflation, again, I think more problematic. It's just the tipping point of when inflation becomes a true cost to individuals, because it is, it's a tax. It's an indirect tax. It erodes purchasing power. And then last out of COVID, just the belief that that it really reinforces to me, not just the rebirth of manufacturing, but it goes hand in hand with, if you start with a blank piece of paper and you're thinking about how I'm going to allocate my stock portfolio, 80 to 85% arguably should be in domestic stocks. The remainder should be in emerging markets to balance a little bit of nitro with stability. And all you have to do is look at Europe and pockets of Asia to see that there's just simply no growth there, and the markets just don't give you the return. The bottom line is, since 1987, U.S. markets have compounded 500 basis points or 5 percentage points, compounded better than developed markets. So here we are in October of 2021, and a secular outlook, I think, for manufacturing, or that reopening 1.0 that I argue started to develop about 8 or so years ago, I think that's more intact. The cyclical forces, I think, go to the fact that we're about top of the third inning in this cycle. And the more and more you look at the metrics, whether it's on the macro side for things like an ISM manufacturing index and new orders in particular, or you look, in my case, is just as much at the micro, and the micro probably matters more, is what are companies telling you? And in this third quarter earnings season, it's early, but revenues are up about 15% year on year, earnings are up about 30% year on year, and the tone out of companies, they're always a little bit guarded, but the tone so far is nevertheless the same. Business is pretty darn good. They shored up their balance sheet when the unknown of COVID took place in 2020. Now they're benefiting with better revenue and sales growth and earnings growth and free cash flow growth and margins. And it's not just in the mega big caps, but we're a lot of places where we traffic in small and mid cap stocks. I think the story is arguably even better. Michigan manufacturing, I think the outlook is just as favorable. When I look at the metrics of Michigan, and I'll get to them on an apples and apples basis with the US, I think that we're as good or better in most of our metrics when I can compare Michigan against the US. Now, if we think about 8 years of what's been really good for manufacturing, you can run down this list very quickly. And Tom alluded to it. Productivity has been exceptional, I think, and best where it's measured in a goods sector. It's hard to measure it in the service sector, right? I think I'm a lot more productive than I was 10 or 15 years ago through technology, and 10 years ago, we're more productive than somebody who managed money in the 80s, just because you're just simply so much more efficient. But where you can really measure it in a good sector, the manufacturing sector, it's very good. Profit margins, I said, have been particularly improving, but they've been improving most. The empirical evidence is there in the manufacturing sector. I said free cash flow margins today are averaging about 12.5%. The long-term average is a little less than 10. But where the best gains have been in manufacturing. China, always on everybody's minds. What you're seeing in China is just a continuation of the last several years where they are becoming less and less competitive. Their costs have gone higher and higher, and it has put the U.S. at a better ability to compete against China than what we would have thought 10 years ago, or what people were thinking 30 years ago when it wasn't China, it was Japan. But if you looked every year at the Heritage Foundation comes out with an index of international competitiveness.
Now, the U.S. is no poster child as being one of the most competitive countries, but we're still in about the top 10 to top 15. China, way down the list. The same way Japan was uncompetitive, the same way most of Europe was uncompetitive. It really told you the story that the manufacturing 1.0 reopening was about to take place. Michigan's tax climate has improved, I think, measurably in the last 8 to 10 years. Pretty quickly here, I don't know exactly when, but in the next few days, the Tax Foundation will come out with arguably the most rigorous study on tax business climate. The last one was just about a year ago. Michigan ranked 14th in the country. We've been hovering between 12 and 14 the last few years, 12 at the best, 14 more recently, not because we've done anything bad, it's just other states aren't sitting on their hands. They look to become more competitive too. It'll be interesting that when quickly we see the next one is Michigan still number 14, but nevertheless, whether we're number 14 or plus or minus some number around there, it's a far cry from when we were below median 8 to 10 years ago, but we've become much more competitive. On a micro basis in manufacturing, and I'll cover the autos in more specifics, their ability to be good allocators of capital has improved measurably. Wall Street would always tell you, you bought the autos when they cut the dividend and there was blood in the streets and valuations looked rich because there was no E or lack of E to calculate a price to earnings ratio. So it was the time to buy them, but you dated them, you didn't marry them. And I never thought in the 33 stock strategy I'd manage, and there's a mutual fund, that I would own an auto, because in 33 stocks, you got to fight for your shelf space. But I own some GM because I think the long-term secular story is there, not just the electric vehicle story, but they're just a better allocator of capital than they were before. They're better positioned. And I think, for what it's worth, I think the macro backdrop is better as well. It's been an environment that's been, as I said, really good on reshoring versus offshoring for U.S. business. If you look at S&P companies, large, mid, and small, and you look at the industrial space, which is mile wide but an inch deep, but you look at dissecting the performers between those with a higher exposure to U.S. sales versus a lower exposure to U.S. sales, bucket A and bucket B. Bucket A with a higher exposure to U.S. sales, those stocks have been, on a relative basis, faring better. And that's shown up in auto, electrical equipment, medical equipment, across the board. The states where the onshoring is taking place, Michigan is benefiting. We could benefit a little bit more, but North Carolina, South Carolina, Indiana, which should be in our bullseye as an objective on a state competitiveness index, because they consistently rate a little better than Michigan as a state to do business. And the outcome, if the stock market is a good gauge, is the last 5 years, U.S. industrial stocks have compounded at 15%. In comparison, Asia, 10%. Developed markets, less than 10%. If the stock market is that voting machine, you have a feeling like this manufacturing 1.0 reopening has the ability to keep going. So quickly, in terms of trying to score the cyclicality of the economy, I said the Fed had the toolbox in March of 2020. They have been in monetary overdrive. They've been on steroids. Tom alluded to the numbers. M2, to be a little bit of a data geek, has grown 34% off, point to point off the March 2020 lows. Now, to be even a little bit more of a data person, high-powered money, monetary base, doesn't get mentioned as much, but I think there's a higher multiplier with that, has grown 75% off the March 2020 low. If you look at a trend line of money growth, what I said was it put the great financial crisis Fed stimulation child's play. And it took them a while to recognize just how tough the GFC was going to be. And this time around, throw it in, add in the fiscal stimulus, and you have the combination of federal and fiscal stimulus, not even measuring the potential infrastructure deal or the reconciliation bill. It's 43% of GDP. That is unprecedented. We've never seen this kind of stimulus, and no surprise, the economy has responded quite well. Balance sheets, I think, are in much better shape for corporate America than they were in 2008, if you could try to draw a apples and apples comparison. I mentioned revenue and earnings growth for, second inning or so of the third quarter earnings season is growing quite healthy, free cash flow margins. There's always risks, right? For what it's worth, the biggest risk is the risk you don't know, right? We could survey everybody in here, and you're going to say, give me your biggest risk. Well, inflation. You're not hearing on CNBC or Bloomberg anymore that it's transitory. Those who are referencing transitory are just, they're wrong. It's just, it's fallacy. You can't grow money at better than 30% and not expect it to eventually be an inflationary event. So Friedman was the one who said that first. Inflation is first and foremost a monetary event, and I think for what it's worth, okay, the long-term inflation rate's been about 2%. The last few months we've been running 5% and change year on year. To me, as much as you can pinpoint it, it's a combination of what's inflation doing combined with what are interest rates doing. And to me, the tipping point, if that's the right word, is inflation that's more sustainable when it gets above 4 to 4.5%. That's when stocks don't keep up with inflation. That's when interest rates, which God bless anybody who thinks they can forecast interest rates, they're going to be wrong more than they're going to be right. As a former economist at a bank who spent a lot of time trying to forecast interest rates, more wrong than right. Nevertheless, if you're asked your opinion, I think they're trending higher because a 10-year treasury at 1.6% yield, net of inflation, is significantly negative. Real rates, they don't stay that way for a long time. You can argue why they're low, and they're good arguments why they maybe don't go as high as what would be really prohibitive to your cost of capital and your ability to generate profits. And it goes something like this. Corporate pension funds in particular, I sit on Beaumont's investment committee, we're trying to say we don't want to be in a pension fund business, we want to be in a hospital business. So we're trying to immunize our liability stream, and how are we doing it? Through long duration investing, buying long duration securities to immunize our liabilities. So even though in our heart you kind of feel like, do I want to buy an investment grade bond that yields 2% at best when inflation is what it is? Probably not, but I don't want to be in a pension fund business, so I'm forced to buy these long duration assets. Or as much as our interest rates are unappealing, they're even less appealing in Europe and other parts of the world, so they want to buy our securities. Or just the simple rebalancing in pension fund portfolios of stocks have done so well, bonds have not. I still feel like stocks are the place to be, bonds are, but I have to force by my investment policy statement to rebalance. So what I know in my heart, maybe to be wrong, is I just have to take some risk off the table, sell some stocks, buy the unattractive asset class in bonds. And what am I doing? I'm keeping interest rates lower. The same thing in something as simple as 529 plans, right? Or target date investment plans. You're seeing the forced buying of fixed income securities when you know, if I had a blank piece of paper, why would I want to own any treasuries or even investment grade corporate bonds? There you can make a little better case, or private credit. But I think it keeps interest rates not going terribly high, but I think directionally it's still going to be problematic. Labor markets are going to stay tight. That's the other buzzword I'm watching or listening to on third quarter earnings calls. Anecdotally, you see it when you drive anywhere, and the help wanted signs and the bonuses that are being offered for signing up with a company. For what it's worth, every month the Small Business Survey, National Federation of Independent Business, are jobs hard to fill? over 50% for 3 months in a row say yes. If I were to show you that chart for 40 or 50 years, it is off the charts. It has never been that high over 50 years of data that they've done this. And this is as good as it gets. It's 800 small businesses that they survey on a lot of things like what's your biggest problem, taxes, regulation, and hiring, what's your optimism level. Check it out if you care. If you look at the chart, it just tells you labor markets are tight and they're going to stay, I think, a challenge. Taxes and regulation, good luck guessing that. I always feel like if I'm managing money, I'm going to expect government to do the least amount to solve a problem, and that's where it stops because I can't forecast government policy. You know, tax rates are going higher, but nevertheless, I think good companies on a micro basis will find a way to deliver shareholder return, be good allocators of capital, even in the face of higher regulation, higher corporate taxes, higher capital gains taxes, higher marginal rates on income. It's not going directionally correct. But I said at the beginning, this manufacturing rebirth or renaissance started in a higher tax regulatory environment during the Obama years. You can't stand up here and say at the end, without having some opinion on the supply chain issues, right? It may sound too simplistic, but it's just good old supply and demand, right? Out of all this stimulus, demand was higher than people expected. Consumer balance sheets are as good as I've seen. If I take away corporate free cash flow and try a metric like consumer or household free cash flow, it's just as impressive. For every dollar households have generated in income, they've only taken on 50 cents of debt. So their balance sheets are really good. Demand was stronger. Supply was constrained, whether it was because of COVID or droughts in Taiwan and the amount of water that needs to be used to manufacture semiconductor chips. And you had this supply-demand imbalance that I think eventually gets solved sooner than maybe what the press is thinking about today. Just with the simple belief that the private sector has a great way of responding to these challenges, and whether it's first quarter of 2022 or shortly after, I think anecdotally we'll be hearing less and less about supply chain constraints because the private sector will figure it out. And if the government can maybe not try to intrude or try to be the solution provider, I think that will be the best thing, right? There's, you know, our ports aren't open, their ports are 24/7. Why? Because of regulation and, politely said, longshore union. But to the extent you can fix that and just let supply-demand forces work, I think it's going to be a thawing. We're already seeing it a little bit in the auto industry. More plants are coming online. And I feel like the prospects are pretty good. So to wrap it up, when I think about Michigan, I think about this. My scorecard for Michigan looks pretty good. Prosperity. Simple. Job growth plus income growth equals prosperity. Job growth plus income growth. Michigan, as of mid-2021, job growth plus income growth, with income being the big factor, 20% growth, USA 17%. Unemployment rate, right, we spiked to 15 or so. We're below 5. Our unemployment rate is back below the US. Not that that's the be-all, but it's a decent metric. Stocks, for Michigan stocks that I follow, over the past 12 months, they've grown faster than the S&P 500. Watch when that tax foundation study comes out. Should be coming pretty quick. See if Michigan still stays in the top 15. We're number 14 on the last measure just about a year ago. At one point, we're even more competitive than, heaven forbid, the state of Texas by a penny, but we're more competitive. On the auto side, it's rare that I've owned an auto stock over the years, but I own GM. Not in a big position, but nevertheless own it because I think there's more long-term capital allocation, good things that are taking place. And what's also good on the macro, to wrap it up, is this. Income growth after inflation and taxes in auto terms. Green light. Consumer balance sheets, green light. Average age of a car on the road, 12 years. That's a green light. Scrappage rates are going to go higher. Density rates, the number of cars per household, is going to go higher because growth in driver's license and demographics of those who are coming into the sweet spot to buy a car as baby boomers move towards their more mature years, that's been, I think, a positive factor. EBITDA margins or EBIT margins, I think, are steadily improving, reflecting the fact that the auto companies are better allocators of capital than when they did deals like owned Saab or Jaguar, to date myself a little bit. And that's why I think at the end of the day, we're going to have manufacturing rebirth 1.0. Didn't come with the vaccine announcements in November of 2020. I think manufacturing rebirth renaissance came roughly about 8 years ago when you started to see these secular changes unfold. And really, as much as you can look at it arguably, I think they're still intact. And the cyclical recovery we're in, where I said we're about the top of the third inning, that bodes quite well. And for the risk you don't know, or the risks that you're worried about, like taxes and regulation, they'll slow it down, but they're not going to be enough to stop this rebirth that's been taking place in U.S. manufacturing. And I see it every day in the companies that either I own or I'm thinking about, whether it's on the big mega cap, large cap side, or on the small mid cap size. And it really, I think, translates to a number of very fine publicly traded Michigan companies. So I'll stop there, because I think I hit my mark. And I always say I like a few questions, so make me happy if you would, please. Ask me a question or two. So labor force participation rates, start with, I'm going to try to think of the chart. If you start with the Reagan years, they were going steadily higher. Even before that, right? Or politely said, more people entering the labor force, particularly on the female side. It's declined. I think it's a slow road back. And you know it anecdotally. Have we incentivized people to work? Maybe slowing down the very generous unemployment benefits invites them back. But I think there's a secular story where, even in my household, somebody decides, I've worked long enough, time to enter the next stage of, what we'll call retirement. I think it's a slow road back, because out of COVID we have created a disincentive to work, sadly. Other questions? Yes, sir. I'm sorry, repeat the first part? Oh, the child tax credit. The child tax credit it's a nice enticement for middle to higher middle income individuals. And if you learned any, I think, I'm a slow learner sometimes, is that these transitory policies or these temporary policies have a great way of becoming permanent. So we've created even another disincentive to work because these generous tax credits. Now we're going to find out when somebody has their tax bill that they don't get this great deduction because they've already taken some already. Maybe that has an impact, but these are just more disincentives to work. And with respect to the political parties, they're not dumb. They figured out how to give more goodies to higher middle income individuals to, for lack of better words, buy their vote until we realize, I know Goldwater didn't say it first, somebody said it before him, a government that's big enough to give you everything you want is big enough to take it all away. And I think directionally that's where we're headed, sadly. It's just up to good companies to find a way to continue to deliver shareholder value in the face of that. Well, for the years I get to come to UHY and do this event, it's always fun because it's, if data's the plural of anecdote, I see an anecdotally when I listen to companies' conference calls or go to investment conferences or just earnings calls about what I'm seeing in U.S. business, but then particularly in that people who make something, right? Goods producing companies, and it's great to have that conversation with you this morning. So thank you always.
you so much. Always insightful. You know, and I even had my magazine up here when I got on my slide about this ESG, environment, social, government. This is making front page news, you know, and this is what's going to impact, you know, even our manufacturing supply base as this becomes, quite frankly, a bullseye for companies to become more carbon neutral. Absolutely. And we agree. The labor, we mentioned in our opening, the skilled labor gap is not new. Just got tougher because of COVID. So lots of change, and I just hope more investment in skilled labor and trade schools will accelerate. Get people interested in manufacturing again. So next, very excited, we have Dan Bruce. Dan Bruce joined us about a year now, and he's a senior manager in our consulting transformation group, and really focuses on strategy. And we have so many clients, you know, in these past several years, really trying to look at directionally, where do we go? Where do we go? And, you know, there's lots of options, and we need to have a plan. And Dan is an engineer by trade and has a very precise plan, and that's what we like. And very well thought out, lots of great data, and very experienced across many sectors. Certainly manufacturing is a key one that we focus on. So I want to welcome up Dan Bruce, give us some insight into strategy.
All right. Good morning, everybody. Very excited to be here today. It's great to be at this hybrid event and be speaking with some colleagues, clients in person, and not just staring at the camera like I have been for the past 2 years when I do events like this. So, as Tom mentioned, my name is Dan Bruce, and I'm a senior manager in UHY consulting practice. And the focus of a lot of my projects is on strategy consulting. So what I want to do here today is talk to you about strategic planning and how you can use strategic planning to drive growth and capture new opportunities. As a strategy consultant, I advise many clients on the strategic planning process. So I want to take some of that experience that I have and give that to you today and saying, why should you prioritize strategic planning? What are strategies that you can use with all these trends that we see going on? What are the benefits of it? As well as I want to leave you with a framework so that you can take that from this conference and kind of start strategic planning if you're not doing so already. So to start off, so this is a picture of my dad and I on a fishing trip in New Mexico. My dad is a huge fly fisherman. I'm not as into it, but I do enjoy going on trips with him, usually annually. We'll go around Michigan, but every once in a while we'll do something pretty cool like a trip like this. So growing up, not a big fisherman, but I would fish. There was a pond near my house. I'd go to that pond. I knew there were fish there. I had equipment, so I had my traditional fishing pole. I had a small tackle box. I'd usually buy some worms, and I would use that to go fish. I'd say I was moderately successful. Usually while I was there, I would catch a fish or two, and just catch and release, I'd throw it back. And I did that for a while over time. And again, moderately successful catching fish. But as time went on, I started, as my dad got more into fly fishing, I'm seeing these pictures of these trips he's going on and some of these other places that he's going. And I'm thinking, man, that looks a lot more fun than the pond I'm fishing at. I want to grow my fishing experiences. I want to have some new opportunities. And I wanted to get on board with that. So he had this trip going to New Mexico. I decided to tag along with him. It'd be a good thing to do. But this is very different as you see where we're fishing versus the pond I talked about in the beginning. So I could probably have showed up to this river that we're looking at and brought my same equipment, my fishing pole, my tackle box, brought some worms, and thrown it into this river, and maybe I would have had some success. But that wasn't the goal, you know. I wanted to grow my experiences. I wanted new opportunities. I wanted to go to a river like this and catch some big fish and new fish. And so I knew I couldn't just do the same thing if we wanted to do that. I decided I needed to do some planning, almost some strategic planning before we arrived here. And so we did. You know, we had a vision and mission, and we knew what we were going there to do. We had goals. Our goals were catch fish. We had KPIs to track those goals, okay? How many fish each of us catch, and how big are those fish? So we had all that in place. And the next thing was, okay, we have to plan out our strategy a little bit and do some strategic analysis. So showing up at this river, very different from the pond, have to do some research into that. So what's the water level at this river? Do the fish want to bite at flies that are floating, or do they want flies that are under the ground, or that are more in the water? What's the hatch? What's the bug that they're biting at? You know, doing all this research helped to increase our likelihood of success and make sure we had a better time when we were out fishing. So this is a manufacturing conference, not a fishing conference, but I tell that story because I think there's a lot of parallels in what I did for that trip to increase my likelihood of success, what you can do as middle market manufacturers with strategic planning to increase the likelihood of success as you look to drive growth and capture new opportunities. Let's transition from the river back to manufacturing. Why should you prioritize strategic planning? Well, typically companies that prioritize frequent strategic planning, they see 4 benefits. So 1, you seize growth opportunities. So this could be, hey, maybe we are making components in a particular industry. Is there another industry we could make similar components for and grow that way? Another is increasing profitability. So maybe you're doing your strategic planning process and you're discussing your operations, and you say, are there ways we could improve our processes or take a look at our processes that we could cut out waste and improve our profitability and grow that way? They create competitive advantages. So in the research and analysis phase of the strategic planning process, maybe you discover, hey, there's a customer need out there that's currently being underserved. We fill that and create a competitive advantage in the market. And they react quicker to disruptive trends. So business world today is very highly complex, moving very fast, and there's disruptive trends that can come in and really threaten your business or potentially wipe it out. So by doing strategic planning, doing the research and analysis, you can get ahead of those trends and make sure you're prepared when they come. So we've touched on this now. Tom touched on this a bit, and Stephen's going to touch on some of these as we go forward. But it's been a challenging past couple years for manufacturing. I'm sure everybody in this room has had at least one of these trends, if not probably all of them, touch their business. And just to kind of set the stage again on some of these. So Industry 4.0, that's not necessarily a new trend, but what we're seeing is there's technology advancements. It's starting to increase. And you're also starting to see things like automation as we're having labor shortages. Maybe there's more of a need for that. Can we fill these roles? We can't fill them with people. Is there ways we can automate or improve the process that way? One of those technologies that's increasing is 5G. So now with 5G coming, it's faster speeds, lower latency. You can connect more devices to this and still work at the same efficient pace. You know, even outside, we talk about just the manufacturing floor, but what about some other services that occur in the manufacturing workplace? So, for example, augmented reality. So maybe in the past you needed somebody who was good at fixing this or was qualified to fix a particular piece of equipment. And that person had to be there, or if the equipment went down, that person had to be flown in to fix it. Well, now with augmented reality, that person can be sitting somewhere else. You can put on these glasses and they can walk through a somewhat qualified person on how to do that repair, or maybe how to do that complex assembly, or maybe how to do a quality check. So that's all things with Industry 4.0 that are coming to the industry and really changing things. You know, below that we see ESG, environmental, social, and governance. So the tracking and reporting there. And as Tom mentioned, the OEs are starting to do this. You're starting to see them tracking this, reporting it. And what that means is, if you haven't already seen it already, it's going to start to be pushed down into the supply base. So that's another thing to be prepared for. Supply chain disruption. We all know the chip shortage. And one of the biggest complaints as I'm working with clients, or biggest questions I get, is about steel prices. And we're seeing the raw material price increases and shortages there. Product and service innovation. So you have new materials that are being introduced. We've seen the advanced high-strength steels, things like electrical steels, as we're seeing more electric vehicles come into play, as well as carbon fibers, things like that. In value-add services. So as a manufacturer now, maybe you're not just manufacturing the product, but you're expected to also be able to service it after or install it and do these other things. So that's starting to creep in. The labor shortage, so the lack of skilled labor, high turnover, even the need for more technology positions. We're kind of seeing a change in what's needed in the manufacturing environment with things like Industry 4.0. And then reshoring. COVID kind of exposed this, and as we've talked about it already, people are reevaluating their supply chain. Just in time may not be what it was before. You may need to have more stock of critical components and inventory. There's executive orders, as Tom mentioned, to take a look at the supply chain and what's critical. There might be more dual sourcing. So these are all trends that are floating around that you need to do strategic planning to be prepared for. And on top of that, I'm sure we have a lot of automotive suppliers in attendance. We can't talk about trends and disruptions without talking about electrification. So if you are in that space, whether you're making, especially if you're making components related to internal combustion engines, the time is now to start paying attention, if you haven't already, to what's going on. And I like to use this chart to kind of point out why. So it's going to be a rapid, or projected to be a rapid acceleration in the adoption of electric vehicles over the next 10 years. I like to use this graph to show kind of what that means, especially if you're a supplier out there. So this is the technology adoption S-curve. And if you look at the x-axis, that's a customer type. If I start all the way at the beginning, you start with your innovators. So these are people that not very price sensitive. They just want the latest, greatest thing, they're going to buy it. Next is the early adopters. So they're a little more price sensitive, want to make sure the product works a little bit before they get into it, but still on the early side of the new technology. In the middle portion, you have your early and late majority. So that's the masses who are buying a technology. And finally, the laggards. So that's where basically they're buying it because in this case, maybe there isn't much ICE or internal combustion engine vehicles left, so they have to jump on board. Your y-axis, that's the percentage of market share. So what percentage market share does this technology have? So to put all that together, if we look at where we are with electric vehicles in the US, in 2021, we've kind of just creeped out of that innovator phase, starting to be in the early adopters. But you look just 8-9 years ahead, 2030, all of a sudden we've moved to what they're projecting the market share to be in now your majority. And so if you're in this, whether you're making specific internal combustion engine components or not, it is critical that if you haven't already, you start to focus on building a strategy, planning a strategy, developing it, because you're much more likely to have success if you do that before it reaches into the majority segment that's going to happen here soon. So we look at all the challenges. We look at the trends that are going on, some of the disruptions that we see. But the good news is there's growth and opportunities ahead. So this is the result of a question from UHY's manufacturing survey. And this particular question was, what level of revenue growth or decline are you expecting? And you can see that over 80% basically of respondents said that they're expecting growth over the next year. So we take all this together, we see there's all these trends going on. There's disruptions, yet there's growth. And that's just why now is the time that if you haven't, to put a strategic planning process in place so that you can help navigate all these trends, mitigate risks, but also capture all this growth and opportunity that we're seeing come out of that. So first, just what's a sample of strategies that can be taken when we're talking strategies? And there's a whole mix that I work with clients on. And so if we look at the top, first there is market strategy. So I'm going to use a automotive supplier as an example. Maybe you're making an automotive component today. Could you maybe look at a new market or a new industry? Could you make similar types of components in aerospace or maybe in major appliance? Could also be a product strategy. So can we innovate our product? Is that something we can do to grow? Maybe start to put a new material, make it with a new material. Will that improve margins and help us to grow? Operations. So when's the last time we've taken a look at our operations and maybe mapped out, do we have up-to-date processes? Now, we're talking about the labor shortage and how there's all this need for bodies, but if we take a look at our process, how much waste do we have in it? Is there a way that maybe we don't need to fill those positions anymore because we could just make our processes more efficient and eliminate that? That could be part of an operations strategy. The M&A side, so an acquisition. It's a way to buy scale or maybe improve your market position. On the M&A side, it's a way to quickly enter a new market, like buying into those customers and those capabilities. The other side of that's a divestiture. Maybe you take a look now at your company and its portfolio and say, are we focused on the right items? Are there areas of our business that are actually dragging down our profitability or aren't a key focus of ours? Maybe it makes sense to divest that. And finally, a JV or partnership. So this is another way that you can increase your scale and improve your market position. And you do this by basically sharing resources with someone else. So this is a list of sample strategies that are out there. We've done some surveys, and there's been surveys that have been done by some other firms. So let's take a look at, hey, what are people thinking of as far as what are their strategic priorities that they want to start to implement? So this is from UHY's middle market survey last year. So there is one in place right now that we're still gathering the data for. But as of last year, we had a question that said, in what ways are you preparing for the post-pandemic road to recovery? And if I look at this, and you had to rank your top three, what are some of the key priorities that people are putting forward? Well, first, operational efficiencies. So we talked a little bit about that. This is improving your operations to make them more efficient. This is, do you have you mapped out your processes? Are they up to date? Is there ways to eliminate waste? That's one of the first priorities. Number two, market or product expansion. I think a lot of people were in maybe one market, and when that goes down, they might realize, hey, it'd be great to be diversified. Maybe not have so much risk in the one market we're serving. Is there a way we can expand and diversify our products or the markets we're in? And then third is technology improvements. So we talked about the trend of Industry 4.0 and automation and improving things that way. So looking at this, you can see people are prioritizing these as we came out of some of the COVID disruptions, and these are the strategic initiatives that they're looking to put forward. But if we look at another survey, so I'm not UHY biased, if we look at a PwC survey of, hey, they looked at family businesses, what are some of the priorities there? You actually you do see similar trends. So the top ones listed there were market or product expansion and trying to diversify, eliminate some of that risk, and the technology improvements. So, what this shows as we look through all the surveys, we see growth, we see people have strategic initiatives and ideas in place. So why aren't we seeing them implemented? Why isn't there planning? Why isn't there development? Why isn't there execution? Well, there's roadblocks to the strategic planning process. Now, I thought this was an interesting stat that I found from a Harvard Business Review. It said 85% of executive leadership teams spend less than 1 hour a month discussing strategy, and 50% spend no time at all. So as we focus that down on, okay, in the middle market space, why is that? Well, one, your organizations are getting more lean, and your leadership team's responsibilities are increasing. So one, there's not a lot of time in your day. There's not a lot of time to prioritize the strategic planning. You know you need to do it. It's just trying to find time with all your daily responsibilities to get it done. And most middle market companies don't have a big strategy team that's sitting there and doing that research and analysis that you need to do. So a lot of this falls on the leadership team, which again, don't have a lot of time to do. The other side of this is these decisions are complex, usually very stressful. There's usually a lot of uncertainty. I mean, we're talking about things like maybe buying another company or starting a new product line or redesigning your operations. So there's a lot that comes with that. And so I call these, you get the question a lot, what keeps you up at night? This is what keeps you up at night for the one or two reasons. One, you have your daily responsibilities, so you're doing this late at night because that's the only time you have to do it. Or two, these are such stressful decisions and it's hard to make them, that is what's keeping you up and stressing you out. And so that's where, the good news is an advisor like UHY Strategy Consulting can come in and help you. We have the experience in doing strategic planning so that these are your executive leaders doing this process. So having an advisor like us come in and help, it helps to make it more efficient. So you're not using everybody's time or wasting everybody's time. With that experience, we have access to data. So we have data that we can use to help drive data-driven decisions. So yes, these are stressful decisions, but if you apply data to it, it makes it easier to come to a conclusion. We have templates and frameworks that can help take all that complex data and simplify it and put it in a format so that it comes back in front of the leadership team. They can make quicker decisions, and it makes a lot more sense. So to go back to the river one more time and further emphasize this point. So I talked about how my dad and I did the strategic planning to increase the likelihood of success as we were fishing. But you'll notice in the first picture, my dad and I have big smiles, but we don't have any fish. What we did, we had a guide come that I would relate back to kind of doing the parallels to an advisor who was familiar with the river. He knew where to fish. He knew he had done this before. He knew the type of equipment that you needed in the lures. And with that, that's when we caught the big one. So I did beat my dad on this trip with the biggest fish. But again, it's a fishing example. It's light, but it just shows how having someone who has experience in this process to come along and help you through that strategic planning journey, how that can help you and increase the likelihood of success. So one of the goals I said I wanted to leave people with today was, okay, what's a framework you can use to get your strategic planning process going? So this is it. And you can see there's typically 3 phases in this. The first one is strategy reviews. The second one is strategic analysis. And the third is strategy development. And one key on this slide is this is not a one-time event. So depending on how much strategic planning you've done in the past, you're always going to start at the review process. But you're going to do a continuous, this is something that needs to occur, whether it's monthly, quarterly, semi-annually. It's a process that you have to keep going because as we saw, all these trends come into play. And it's things that you need to make sure you're prepared for those as they're coming. And is the strategy that you have in place, are the goals that you have in place still aligned with what's going on in the market? So over the next couple slides, I'm going to walk through each of these 3 steps in a little more detail and talk about the key activities that you need to perform to help ensure you have a better likelihood of success. So you start with the strategy reviews. So this is typically a meeting with your leadership team where you're talking about your vision and mission, your goals and objectives, your competitive position, and your strategic initiatives. And you'll see the first item on that list, vision and mission. Your vision is critical. So this is something where if you do not have a vision in place right now, it's the first thing that you need to do. Your vision sets for your entire company, both the internal and the external stakeholders. What are you aspiring to be? What is your company here to do? And if you don't, and what you need to do is all decisions that you make should be aligned back to that vision. Are we doing this? Does this align to our vision? If not, probably shouldn't be doing it. So that's the very first thing. And if you don't have a vision in place or need help with that, that's a whole nother exercise that can be completed with the help of UHY Consulting as well. But that's number one, because you need that to set the stage for what you're looking to do going forward. So if you do already have that in place and you're in one of these review meetings, you just review that again. That's just to keep everyone aligned with what we're looking to accomplish. The next step is short-term and long-term goals. So now you have your vision in place. You need to set goals that are going to tell you how you're going to get there. So they need to be specific, they need to be measurable, and again, need to align back to the vision. If this is the first time you're doing this process, you're going to be setting these goals. As we said, if this is now semi-annually or quarterly that you're looking at this, well then now you're going to be saying, hey, how are we doing to those goals that we set a while ago? Are those still goals that make sense with the trends that we're seeing? Also want to look at your competitive position. So this is something where look at your company's strengths, look at their weaknesses. What are opportunities that are out there in the market? What are threats that are coming? This is some of that trends analysis that we were looking at earlier. and making sure that, hey, the strategy we set before or that we're setting now has to align with that, and are there opportunities that we should be going after? And then key performance indicators. So that's just on your goals. You need ways to be able to track those. If you're not tracking them, and every time you get together in one of these strategy reviews, taking a look at how are we doing to how we thought we were going to do, you're not going to be accomplishing your strategies or progressing forward. So this is an example. This is to go back to the UHY manufacturing survey and taking a look at a couple of the questions that were there. And these are discussions you could have in your strategy review session. So first question, how is your business approaching Industry 4.0? Well, if we look at the response there, about 77% of the respondents are saying it's not a priority right now. So that's something in your strategy review that should come up as discussion as you look at these Industry 4.0 trends and say, this is starting to move into the middle market. Is this something we should be prioritizing more? Second, please rate your readiness for process improvements. You see there, a large chunk of respondents said, we don't have up-to-date and well-documented processes. We looked at the strategic initiatives that people had in place, and operations was number one on, I think, both lists. So that's something, hey, is that something we should be doing? Should we be mapping out our processes? Should we be looking at how efficient they are? These are the type of discussions you should have in your strategy review to help figure out the next steps. So the second step in there is the strategic analysis. And this is research and data analysis that's needed to help determine what's the best strategic approach. So for example, we were talking about entering a new market or a new industry. Well, here, this is going to need to do some research on that. What industries are growing? What's the size of those industries? What capabilities do you need in those industries? Do we have those capabilities, or is that something that we're lacking? Could we serve it ourselves, or would we maybe need to buy new equipment, or maybe go acquire somebody to enter that? This is a very heavy research and analysis phase, and another area that I help a lot and advise a lot of the clients on. Again, because it's a lot of time goes into this, and you probably don't have the time to do it. So our team is very good at going in, doing this research and analysis, and putting it together in a format that help you make decisions. What comes out of this is, okay, now we've found what areas have the most growth, where should we be focusing, and you also then determine what's the best approach. Is this something we should do organically ourselves, or maybe like an acquisition be a better approach for this? And the final stage is the strategy development. So this is where you create an implementation plan for the strategic approach that you came up with to kind of help progress and set a framework and a roadmap for going forward. So what are you going to do here? You're going to have some strategic initiatives. You're going to assign responsibility to those, so somebody is in charge and held accountable to accomplishing that. You're going to put time frames to these so that when you have your frequent meetings, you can go back and you can look, hey, how are we doing to this? We're past due here. What was the problem? How do we keep this going forward? Really, you have those key performance indicators in place so that you can track how you're doing. Back to that first slide where we looked at this is a cycle process. This isn't a one-time event. So this is how you stay up to date and make sure you're accomplishing what you need to do. So in talking through all that, what are, to kind of summarize the benefits of strategic planning? Well, one, you're creating some proactive strategies rather than reactive. I mean, how many times have you been out there and something happens and you feel like you're constantly reacting to it, just trying to put out fire drills? Well, you put something like this in place and you can be on more of the offensive end. Now you are ahead of these things and you're being more proactive in what you're doing and capturing more of those opportunities. This incorporates data into the decision-making process. So this is going to mitigate some of those challenges that come up and costs that can occur where you make maybe a bad decision because you didn't do the proper research and data analysis beforehand. This also, as you use data, I know a lot of times in these decisions, they're complex and a lot of people have different ideas on how it should be accomplished. Using that data helps to align the team. So now all these people have different ideas, but you point back to the data and it helps get everyone aligned on the same page and all progressing toward the same strategy. It helps to prioritize your efforts and to allocate your resources effectively. So if you have this implementation plan in place, a lot of times I'll go in and advise clients and the team is spread very thin. And so they're doing a lot of things, but they're not able to go in depth or do them very well. Well, by prioritizing your efforts and allocating your resources properly, now you have a focused and targeted attack, and that's going to help your strategy be more successful. And finally, it creates a forward-focused roadmap that's going to align all the stakeholders at the company. And that goes back to the data-driven decisions too. If you have data that's helping you drive these decisions, it gets everybody aligned and everybody on the same page. So who typically participates in this strategic planning process? Well, it's always the leadership team is typically always involved, but other people are going to come and get involved as well. You could have other key stakeholders. So if you're looking to enter a new industry or new market, maybe you have a VP or head of business development that's going to be responsible for that. So it makes sense to include them in the planning process because they're going to have some insights and also need to understand what they need to accomplish. Outside advisors. So that would be like a strategy consulting team or your accountants or maybe a lawyer to come in and be a part of the strategic planning process. And this helps because one, they have experience in doing it so they can make the process more efficient. And two, they're going to bring an outside perspective and help eliminate some of the bias. So if you see on the right, on the screen there's a couple types of biases that can come into strategic planning. And one being recency. Oh, I just heard about this, so that's what we're going to do. Another is inertia. This is what we've always done. So that's the best option. And another is confirmation. And that's where someone, hey, this is what I want to do, so I'm going to find everybody who's aligned with me and every piece of data that points to that and make that happen. So bringing in outside perspective helps to eliminate that and make sure you're making the right decisions that aren't biased. And then maybe also board of directors. They're typically going to approve your plan or be involved and make sure that it's progressing as it should, but sometimes a member or two will also be involved in the strategic planning process. So to kind of summarize this all up, we've talked about why you need to prioritize it. What are strategies that are out there? What are the benefits? What's a framework that you can use to implement for strategic planning? We see all these trends that, yes, the trends look and challenges look scary, but there's a lot of opportunity there, and you can use the strategic planning to capture it. So I want you to leave this conference, whether it's this afternoon or tomorrow, maybe get together with your leadership team and just ask everyone, these 5 questions and see where you're at. The first one, do you have a vision? And is that vision up to date? And does it describe what your company aspires to be? We talked how important a vision is, and so this would be the first question to ask. The second, do you have goals and objectives that are aligned to that vision? So do you have goals that you're working toward? A certain revenue number, a certain profitability number. And are you tracking those? Number 3, do you have a strategy in place to accomplish those goals and objectives? So right now, the strategy that you're working on, is it aligned with a goal? Is that then aligned to the vision? If not, it probably makes sense to take a step back and do the strategic planning to get there. Number 4, do you prioritize strategic planning? So if there's a lot of no's or on the first 3, you probably are going to get to this, and it's also not something you're doing. But that's a question to ask. Should we be? That'll help us get all these other items in place and help us to have a path going forward. Then finally, number 5, are you missing out on opportunities to drive growth and capture new opportunities? That's kind of the final question where, because we aren't doing some of these things, what are we missing out on? Is there a lot more we could be doing? And so I want to thank, that summarizes the presentation today. I want to thank everybody for being here. If you have any questions on anything I talked about, or you take this away, you ask those questions, and you want to come back and talk about the strategic planning process, please feel free to reach out to me or your relationship partner. We'd be happy to talk about it. So thank you and enjoy the rest of the conference.
Thank you, Dan. I think, working with Dan and on strategy for certainly myself for many years, the biggest thing I think we can agree on is really building not so much that board of directors, but that advisory board, and it's bringing in your trusted advisors. It could be someone from industry, someone attorney, someone, you know, a CPA. But building that is just what I've seen with clients. It's been very successful, and we hope that you will take certainly consider that. But the planning that goes in and the amount of, Dan can data mine like nobody. I can tell you that. He's amazing at finding. I don't even know where he finds some of this data. So, but you know, data is very powerful, and you know, we really want to get to a point where we're making decisions based on facts and just a better decision-making process. So we are a little ahead of schedule right now, so we're going to take a little longer break. We are set, and we'll probably return at, if we can, at 10:25, because Stephen has like 3 hours of information to go through. Gonna talk really fast, but it's some, you know, the last two sessions here are gonna be really powerful. I think you'll really enjoy them. So let's take a little longer break here and you know, grab some coffee and drinks. And everyone online, please take a break, and we'll be back shortly. Thank you so much. everybody just a few more minutes. We're going to get started just about 5 minutes early because Stephen has so much material. So, but if everyone can start taking their seats, that'd be great. Well, just a few more minutes.
Mm-hmm.
get started just a few minutes early. No, it's just... All right. I'd like to welcome Stephen Lathrop, leads our UHY's consulting project management team. You know, and he consults on just about, he's just a wealth of information, and he's a tremendous speaker, and we're very excited to have him on our team. So I'm going to let him kind of a little bit maybe introduce himself also here. Thank you, Stephen.
Thank you, Tom. Excellent. Okay, so have to get used to the forward, but all right, here we go. Well, good morning, everybody. It is so awesome to see everyone's faces. I've been working with folks for over a year, got to shake their hand for the first time, and I just am so glad to have that opportunity. So thank you for coming. And for those of you that are still online, thank you for bearing with us and appreciate your attendance as well. We want to recognize you. So today, what are we here to talk about? Policy changes and trends that are affecting middle market manufacturers, which is you all, right? That's why we're here. Mostly what we really want to help you with is, what is it that you can be doing now? What are those things that you can take away, be thinking about, and start taking action on? Obviously, in 45 minutes, we're not going to have the opportunity to lay out the full game plan, but I am hopeful that this gives you some great solid nuggets to dig a little deeper into as we go. So today, what we're going to be covering is an update to an article that I wrote along with Michael Heilman, who is sitting here, and another colleague, Corey McNeely. We wrote just in early January about what manufacturers should be looking for. We're going to update that today because we're 9 months in, right? 10 months in now on this administration. So what are those updates and what are the takeaways and what are those pivots to what we did a year ago? We're going to hit on labor. We're going to hit on supply chain. We're going to talk about energy and the environment. ESG has been a big topic today, and I've got a lot of good info on that. And then we're going to touch on a little bit on taxes and tariffs, okay? So let's just jump right into it. We're going to start with labor and supply chain. The biggest thing is labor, right? Shout out to one of my favorite clients who's joining us here by video. Bob, thanks for joining us. Met with him yesterday, and Bob said, single biggest thing holding me back. I've got a brand new plant. UHY, you helped me lay this out, getting me efficient. Thank you. I can't scale. And I can't scale because I can't find people, right? And I think we're all feeling that. The labor right now, obviously looking at the gray bar on the left, that's when the pandemic hit, right? Everything shut down. Unemployment went up. Okay, well, we're starting to figure this out. The vaccines came in place. We're figuring out how to work around this. And the demand came back, but the labor force has just dropped off. And it's at a gap that's more significant even than before the pandemic. So it's a real problem. But the thing that we really want you to understand is this is not a transient problem. This is going to be a long-term condition, right? This is going for the long haul. So you can see on this graph, we're looking at years and years of time here. We're seeing the labor really drop off. So you've got labor that's 5.7% behind January 2000 levels. This is a 20-year trend. The baby boomers, for the most part, really are moving out or have moved out, and it just hasn't recovered. So, we're talking, Tom, you made a great point, right, about technical colleges. People coming back in and re-embracing technical skills. That has to happen. We've got to bring people back in. But the point that we want to make here for you all, this is a problem you're going to be facing for a while. So what are those things you can be thinking about in terms of technology, in terms of automation, in terms of redundancy, that can help to compensate for a labor shortfall? The pandemic, sure you saw the hit, but we're still 1.8% below pre-pandemic levels. It is just brutal, and I know you're feeling it. So The Great Resignation. We've all heard that. Massive numbers of people leaving. Why are they leaving, right? Why are people leaving? I think, there are a couple of points that have been made. So David, great point. We're disincentivizing some employees. I agree with that. In some cases, we have employees that are leaving for better opportunities, and I agree with that. That's about a third. But looking at this graph that we have on the screen right here, if you were to add up the blues and the black, those reasons for employees leaving really come down to culture, dissatisfaction. That's 59% of the reasons. And it's fuzzy, right? I don't feel like I belong. I'm not sure what my growth trajectory is. Sure, that's fuzzy. But I put out as a challenge to you all that is something that is somewhat within your control. How can we work with change management? How can we work with bringing people into the fold, making them a part of your culture so that they're not thinking, I hate my job, and I've got an opportunity with some money in hand that I can leave, but you want them to stay. You're incentivizing them to be a part of the team. And those are some challenges. That's not always easy. But there are some things that can be done there. The big message is that's really almost 60% of the reason why people are leaving. They're just dissatisfied. They hate their job. They don't like being a part of that team. So something to think about, right? Okay. Supply chain. So looking in terms of supply chain, there's 6 factors. I would love to be able to stand up here and tell you, here's how we're going to do it, step 1, step 2, step 3. It's not true. This is chaotic. It's a web. Each one of these points is integrated to the other point. You go to solve one, it affects the other 5. I think we all know that. But the big ones are material scarcity, freight prices. Wow on freight prices. Difficulty in demand forecasting. Such a unique time. There's no data. How do you forecast? Port congestion. Got some numbers on that are scary. Changing consumer attitudes that are general long-term trends that aren't going to go away. And then obviously digital transformation, helping to automate, bring in that technology. So let's walk through each one of these in turn and let's see what we can do. Let's look at material scarcity. The graph on the left is talking about the chip shortage, right? It's all in the news. There are 2 bars on there that come up to 5% of the S&P 500 companies are really, the chip shortage is affecting manufacturers. That's a lot. That's a lot of manufacturers that are impacted. And what we're finding is working capital, the general point at the bottom here, is something that we need to be thinking about. That's not just money that you have in your bank, that's your inventory stock. That's getting longer leads on your supplies, having flexibility in your timing, are all things you can do around material scarcity. I also like this story from Tesla, and love him, hate him, but I will give Elon Musk some credit. At his core, he's a physicist. And his team, whenever they come to Elon with a problem, and they say, we can't do this, he'll say, you show me the math and the physics that this is physically impossible, and I'll agree with you. But up until that point, you were going to figure this out. Okay. Well, they also have a chip shortage, right? And what did they do? They were creative. What is available on the market? Well, we have a different chip, but our cars don't integrate with that chip. All right, team, go back and rewrite your firmware. So they did. They stayed up all night, they stayed up for a week, they rewrote all of the firmware, and they were able to incorporate the chip that was available on the market with no hiccups in the operation of that vehicle. So you would have no idea whether your car has chip A or chip B. It's creative thinking. And yes, these are challenging times, but are there things that you can be looking at with your team that are along that same lines? How can we deal with the materials that we've got? What can we not produce? What should we produce? How can we take advantage of what we've got? Anything that you can do, that becomes a market differentiator. Okay. Port congestion. Holy smokes. So I took a look at a video yesterday, and there was a news reporter that took a helicopter flight, and it looked like an ocean parking lot. Over 100 container ships off Long Beach Port. So I want to do some math, because all right, it's 100 ships. Each ship can carry up to 20,000 containers. So, hey, I'm an engineer, I can do that math. 2 million containers sitting offshore, full of goods and raw materials that are needed to produce other goods that are affecting you. So why do we have this? Well, we touched on some of these points earlier too. The unions have rules. California has environmental regulations that don't permit for certain emissions that are still in play, and we're only now getting to the point where we're talking about, I think they just started, yesterday or the day before, going to a 24/7 operation. Meanwhile, those ships were just stacking up. It's going to take time to walk through this. But I do agree with, I think it was David that made this point as well. This is not going to be something that we're in 2023 facing these kind of crises, right? It will work itself through. We're going to adapt. I think we're looking at months, not years, right? But in that time, what can you all be doing to deal with what's going to be some serious material shortages? And the port congestion obviously drives up prices. So let's talk about some of those challenges. Freight prices, 325%. Who can absorb that? Show of hands. Yeah, I got that. I'll cover it. Right? So what's that going to lead to? You have to increase your prices. You have to. I mean, that's just too much. Well, everything goes up. So you all are hearing the reports. I'm listening to the news this morning. My tube of toothpaste is going to go up because Procter & Gamble can't afford the freight prices. I get it. It's going to be inflation all over. Whatever you can be doing to manage that as best you can, if you have safety stock, you can stock in advance. Anything that you can do to buffer those prices, that's a competitive advantage. Right? Now you can work that system, even on the short term. Working capital, the message is long term. Sure, this was a global pandemic. It's unprecedented in our times. But there's always an emergency, right? Whether it's a hurricane, an ice storm. And I hate to say it, but given the size of our population and projections, we're looking at pandemics coming more frequently. Not once every 100 years, maybe once every 50, 30, they're difficult to predict, but they are predicting that events like this are going to be happening more frequently. So the lesson should be, I need to be thinking about how to pivot to this, because it will come again. This is business continuity 101, right? Okay. Changing consumer attitudes. Everyone gets this on Amazon. I want what I want it customized, and I want it now. That trend's been going on for a very long time. Amazon has capitalized on that. They've made a whole business around it. Amazon Prime, 24-hour delivery, 48-hour delivery. That gets really tough when you're customizing because people want what they want, and you're trying to automate, and you're trying to expedite the shipping. But that trend isn't going to go away. We're feeling some pain right now, and some of that pain, we can work with it. There's some tolerance for delays. People get we're in a pandemic, but the tolerance and the frustration, the tolerance is lowering, the frustration is going up. People have to get their business done. So this trend, this mentality has to be in place. And you're not going to be able to get it done long term by just scaling with people. We're going to have to scale with technology. We're going to have to scale with automation in order to achieve what this long-term trend is going to be. Demand forecasting. So, I mean, who's got data on this pandemic? I mean, we've been in it for a year and a half. We just don't have this. The last time we had a pandemic of this scale was 1918. So yeah, let me just pull the computer data out from then and I'll just compare it, right? We don't have this data. It becomes very difficult when you're looking at your models and you're trying to take data out of your existing models and apply it to a situation. It's apples and oranges. It doesn't fit. So what are you doing right now to get a handle on that data? Are you contacting your suppliers, both upstream and downstream? If you're producing seats for a car, and the manufacturers are limited but with computer chips and they can't produce enough cars, that impacts your ability to produce the seat, right? You can't produce so much and you've only got so much warehouse space, you only have so much capital. Are those conversations happening very frequently upstream and downstream with your suppliers? Is your MRP system really connected and adjusted right now to be thinking about what we're doing? The data is changing so fast, and those conversations need to be happening, weekly, bi-weekly, to be getting ahead of this, because that's the best data that we've got. So if you're not on that routine, whatever you can do to expedite that, build your partnerships, and make sure you're getting that information in real time, it's going to help. Okay. So digital transformation. And this is a bit of a shocking number. This is a global number. It's not the US, but on a global level, more than 50% of companies have not really integrated technology into their supply chain. That's a lot of companies. That's a lot of opportunity. I know in the US it's less than that, but I would posit that it's still a big number. This is the long-term trend. What you can do to have your data in hand, what you can be doing to manage your technology and your automation today, that's not going away. It's a short-term blip that we've got with this COVID. It's not fun, but the long-term trend remains, and that automation does need to come into play. So at a minimum, if you can't afford the technology right now, like, yes, Stephen, I get that, but listen, I'm facing all of these pressures. I can't afford a $100,000 investment to put in a technology. Do you have a roadmap? Do you know what your requirements are? Do you know where your key pain points are? Has that been mapped out with your customers, with your clients? If not, go ahead and get that in place and start thinking about how do we chip away at this. So you can at least start taking some steps. So labor and supply chain strategies for adoption. We've hit on this as we've been talking. So improving and enacting employee retention. This is fuzzy. It's fuzzy, but it does work. How are you celebrating successes? How are you generating a teamwork framework, a culture? Are people rowing in the same direction? Do they feel compelled to be at your company? Do they understand the why of your company? Who we are, our vision. Is that communicated down to the front line? Do they feel a part of that? Those are things that you can do. It does make a difference, right? It's not just about, I'm going to increase salary. It's about making people feel valued, that they have a purpose, that they're part of a team. Because the truth is, they are. And they are valued, and they are part of a team. So obviously, that's one that you can do. Let's look at some of the quantitative things. If you haven't done it, take advantage of those employee retention credits as part of the CARES Act. If you haven't gotten on that, jump on it, right? That's money that's available. It's part of the stimulus. You're going to be paying for it as part of taxes, which we'll cover at the end of this presentation. So if you're paying for it anyway, you might as well get value out of it, right? Okay. Prepare for the next disruption. We hit on this. It happens. Emergencies, disruptions are part of the normal course of business. This is globally felt. It's a big deal. I get it, but we want to prepare for the next one. And then invest in improving your processes and technology. Again, if you can't afford it now, at least get that roadmap. Start getting your plan together. What are the technologies that are there? You can be doing research. You can engage with people to support you on this to make sure that you've got a well thought out roadmap that you can enact quickly. So when you are ready, you don't have to spend 3 months, 4 months thinking about it. You're ready to act. So, okay. Well, then let's go to this, my fun part. This is my favorite part. As an engineer out of Georgia Tech, I spent the first 18 years of my career as an environmental engineer. And this is part of my passion, and what makes me tick is helping the planet, helping companies to understand how to help the planet. So I'm just going to jump into this and talk about the last administration and where we were with environmental regulations. Pretty well understood that the EPA was pushed down, those priorities were pushed down, regulations went away. What did we learn? 112 regulations were either removed or proposed for removal in 4 years. Specifically, regulations that dealt with domestic energy production, oil, natural gas, drilling. Okay, it was a lot of regulations, and you can see the bar chart there and where those came in. Good for business, right? Things are cheaper. That's great. I get it. Well, what did the new administration promise? And we had this in our article in January. We're going to increase environmental regulations. We're going to get away from fossil fuels. And so we're going from environmental deregulation to environmental re-regulation. So what has happened in 9 months? 65 of the 112 regulations that were either removed or proposed for removal, 73, are already back in place. So more than half have been erased in 9 months. And it's a focus on green infrastructure. It's specifically a focus on reducing fossil fuels. The very first thing that President Biden did on January 20th was kill the Keystone Pipeline. That was the first thing he did. That was the first of the 73. I think everyone knew it. We knew it was coming. It's absolutely here. So, what is the result of all of these regulations? Well, let's take a look. There's a cost to it. Looking at the last 4 on the right vertical bars, that was the Trump administration. The first one is a pretty high number, but I have a call out. That is just the VW scandal, and that was $15.9 billion in injunctive fines, right? So this is you having to pony up money that you don't want to have to because you're not following regulations. If you were to take VW out, because that was a singular event with a singular company, the previous administration had the 4 lowest levels of injunctive relief. That meant that there were less costs on businesses, the environmental pressures, regulatory pressures were off. Understood. That's not going to remain the same. It's just not going to be that way moving forward. We've got more than half of the environmental regulations have come back in 9 months. That number is going to go up. OSHA may not have been visiting you during COVID, and you can see that last bar is very low because of COVID. That will change. That will change. Are you ready? Do you understand the regulations you're compelled to comply with? You will be compelled to comply with new regulations. And are you ahead of it? So rather than reacting to it, it's not only an economic ding, it's a reputational ding. And those aren't good things. So what are you doing to be prepared for that? So it's interesting numbers to look at. That's going to go way up. You can see the red dashed line is the average, and we've enjoyed 4 years of some lower injunctive release, but that's going to go up. Okay. So you're going to be facing environmental pressure, I think well understood from the federal side, from the government side. Federal, state, local, all of those regulations, they're going to be going up. Here's the double whammy. You're getting it from the private sector now. Right? So we've been talking about ESG, and I just want to do a quick straw poll. Show of hands, who has been asked, where's your ESG report? Where are you with greenhouse gases? Do we have anyone here? Okay, we've got a few hands. All right. If you haven't yet, good news is you have a little bit of time because it's coming. It's a big deal, especially with the new administration. A very high focus on climate change, very high focus on reducing emissions. The private sector, what is driving the private sector to do this? Why isn't it just the government? This first graph is showing litigation cases that are related to climate change. Litigation is going up. So this is a risk play. Boards, large companies, they're trying to mitigate and avoid risk. They're being sued. They're being sued around issues with climate change. This shows the top concerns for board members. So you've got everything from, my resource constraints, I've got a suffering global economy, et cetera, et cetera, et cetera. These are your top concerns from the board. The ones in light blue have a direct link to climate change. Again, this is a risk play. If you haven't been asked about it yet, be prepared, and I'll show you why. Let's talk really quickly about greenhouse gases, very, very quick. This is super, super quick. There are what are called 3 scopes of emissions, okay? So if you are a company, you contribute to greenhouse gases in one of 3 ways. Scope 1, direct emissions. You might have a dryer unit on your site, and you're burning natural gas to dry, maybe it's paint, whatever it might be. That's a direct emission. You are responsible for those greenhouse gases emitted from your burner, Scope 1. Scope 2, you have a large, let's say, electric furnace on your site, and you're using huge quantities of power. The power used coal or natural gas, in most cases, to generate that power. Those emissions are generated by the power plant. So those are indirect emissions that you are responsible for. Those are called Scope 2. As of now, most large companies, OEMs, large companies, even some of the big tier ones, have gotten a pretty good handle on their Scope 1 and Scope 2 emissions. We've done what we can within our span of control to lower our direct emissions. We've worked very hard to put in solar cells, reduce our energy output. It saves us money, it reduces our costs. That's great. The big one is Scope 3. Scope 3 emissions are those emissions in the value stream, upstream and downstream of your operations, that you don't have direct control over. So if you buy a product from somebody else, the emissions related in that product are Scope 3 emissions. The pressure on the board to reduce their risks from investors that want to see accountability around greenhouse gas reductions are being pushed to Scope 3. Those are your Tier 2 and Tier 3 providers. You're going to be asked about this because Scope 3 emissions, this blows me out of the water, for as much work has been done on Scope 1 and 2, Scope 3 emissions account for 65 to 95% of emissions. It's most of the emissions. And that's where the pressure is coming down. So what are we starting to see in terms of trends? This is the SEC talking about regulations that they're going to be having around publicly traded companies, putting a shot across the bow that we're going to start taking a look soon about how we look at our publicly traded companies and what they are doing for greenhouse gases around Scope 3 emissions. Here's Stephen Clark, Director of Corporate Clean Energy Leadership, talking about, and read it right here, we do know that suppliers, particularly small and medium-sized ones, are overwhelmed by requests from bigger partners. Why? It's Scope 3 emissions. It's a risk play, and it's being pushed down. So if you haven't gotten asked about it yet, just be prepared that this is coming. So I'm going to put in a quick plug. We don't have time to go through today how to do this, but I've got a 2-part webinar series that I've been working on with the Precision Metal Association. I did one a couple of weeks ago that was a 101 on greenhouse gases. I'm going to be getting into the meat of this on November 2nd. If you're interested, I encourage you to join. You can go in and register for the event on the PMA website. I'll be walking through a direct strategy and how you approach, and even some examples of how you baseline your greenhouse gases. Not time to do it today, but if you're interested, see me after and would love for you to join the event. Okay. So with environmental pressures, regulations, labor shortages, energy's up, right? It's up big time. I'll tell you, I personally saw this coming in about 6 weeks ago, 2 months ago. Just for my household, I locked in natural gas. I was on a variable plan. I put it on fixed, and I committed for a year on fixed. This is going to be with us for a while. This is not a transient event for the next 2 or 3 months. We're going to see energy prices high for a good time. You've got natural gas that's up 113%. That's just this calendar year. That's just since January 1. If you were to look at it from when the bottom really collapsed to today, it's closer to 180%. And I don't see it coming down for a while. So that's going to be up there. Crude oil's up almost 55%. Gasoline, I don't know what you all are paying up here, but I just paid $4 a gallon in Atlanta. I have to use 93 octane, but it hurt me. And it's not fun. That obviously goes into all of your freight costs, transportation, production. It relates to everything. So electricity, Michigan, your electricity prices this year are up 4.6%, and aren't you the lucky ones, but you pay 28% more than the national average for electricity. That's an embedded cost in production. And even that 4.6%, that hurts, especially if you have an electricity-intensive operation. So these two things play hand in hand. If you can reduce your energy, you reduce your greenhouse gases. If you can get ahead of your greenhouse gas reporting and baseline now, here's the good news. Baseline on a bad year, right? It allows for it. The frameworks and the methodologies that are out there, you can pick your baseline year. Pick a year that was intensive. And then set your goals, set your metrics, and work against it. What you're beginning to show for your suppliers is that you're taking this seriously, and you can become a preferred vendor. I'll tell you, Walmart has a project called Project Gigaton, and they are literally looking to reduce 1 billion tons of greenhouse gases through all of their suppliers. And if you are not taking this seriously, you will not be a supplier to Walmart. So it's coming, right? If you can get ahead of it now, you can baseline that year that gives you the advantage. You can look great, get on the preferred vendor list, and move forward. So what are those actions that we can be taking? Number one, we talked about environmental regulations. If you don't have in-house support for environmental regulations right now, that's okay. You can outsource it. You could invest in somebody to come in to support you. There are options, but those regulations are ticking up. And if you can get ahead of it, you can mitigate some risk. Think about the best way to do that for yourselves. Find ways to reduce energy consumption. It's just smart business, right? Number one. But number two, it does play into the greenhouse gases and those scope 3 emissions that are coming. So how can you reduce your energy consumption? And then be thinking also, just in terms of budgeting, with the understanding that energy prices are high. They're going to be high for a while. Do you have that for your 2022 budget, or are you still looking from 6 months ago? So if you need to update that budget, take a look at that, because there will be an impact, and get that into your budgeting process. Now's the time. Pivot to green infrastructure initiatives. There will be continued pressure, even though energy's higher. There's going to be long-term continued pressure to move towards particularly solar and wind energy. Georgia just announced this morning, they're building a new 20-megawatt plant in South Georgia for solar, just in Georgia. And that's a lot. That's a huge amount of area. There are parts that are needed. Think about all of the components that go into this. It could be brackets, it can be metal, it can be wiring, it can be, I need to run underground infrastructure. I've got computer systems that have to maintain and automate this, motors, control switches. If you are producing anything along these lines in an industry that's beginning to decline, if you're producing ICE motors or around automotive, this may be an area, could we begin to pivot? How can we look to producing components and parts that will support this? There's a longer term play here. You've got a little time to think about it. Maybe you can get ahead. Around your supply chain sustainability program, if you haven't done it, the environmental, social, and governance reporting, of which greenhouse gases are a component, are becoming more important. You've got some time to get this done, but the clock honestly is ticking. So how do you do that? Very quick steps, really quickly. Evaluate your industry and your sector, because there are a number of frameworks that are out there You can pick and choose which framework works for you. Pick the framework that your customers and your industry are most supportive of. Look at your gaps and figure out what your key goals need to be. Go ahead and get that planning done. It's not super difficult. There's a lot of information to wade through, but it can be done rather rapidly. Once you've set your own metrics, then you can move forward and identify how to improve upon your own metrics and report. So again, that puts you in the preferred vendor status. And we've touched on greenhouse gases becoming more important. So we're going to touch really quickly on taxes, tariffs, and trade. So taxes. Wow, taxes. We've talked about this today. There's been a bit of a sugar rush in the economy with all of the stimulus packages, the CARE. We've got multi-trillion-dollar infrastructure bills and budgeting, and that has to be paid for, right? It just does, and there's no way around it. The sugar rush has worked. We've gotten a lot of energy and momentum into the economy. We've touched on that today too. Generally speaking, we're doing pretty well, but the piper has to be paid, and that's what's coming. So what's on the books right now? Proposals, looking at the Organization for Economic Cooperation and Development, the OECD, the global average for the corporate tax rate's about 23.5%. Current proposal for the US is 26.5%. I can do that math. That's not good for us in terms of competitiveness. We're already faced with increased energy prices, freight costs, all of this investment, the cost constraints and pressures are all around us. The last thing we need is taxes. So this is going to put us at a competitive disadvantage. I wish I could wave a magic wand to make it go away. I can't. That's also 1.5% higher even than China. So again, that doesn't help. So let's take a look at some of the tax rates that are going up. So the blue bars show where we are today. The red bars show the proposals. So capital gains, 5% increase. Marginal tax rate, 2.6%. Corporate tax rate, 5.5%. Foreign income tax rate, 6.1% increase. It's just across the board. And oh, by the way, another 3% surcharge on Americans making more than $5 million. So, you want your cake, I guess you have to eat it too by paying for it, right? It's coming. I think we all know it. They're trying to work on reducing some of that. The compromises, you all are reading the papers, $3.5 to $2 trillion, just trying still to compromise, but taxes have to pay for this. So where are we on tariffs then? What's interesting is fundamentally the White House hasn't changed much on tariffs. So China's still paying tariffs. Well, they're trying to, but they aren't really cooperating. So the tariffs have really stayed in place. This is all part of the phase 1 program with the tariffs. China's not exactly cooperating. The Biden administration has made the point, don't take any tools off the table when it comes to tariffs. And their proposition is if China's not going to continue to cooperate, then we'll do a phase 2. Well, I don't know that China's going to say, sure, I'm all in for that. And if you've been reading the papers as well, they're having a massive economic problem. The ghost cities are a thing. I was in China a couple of years ago. Whole cities, skyscrapers, completely empty. It's the most mind-boggling thing you've ever seen. And that's coming home to roost for China, so they're in trouble as well. The deficit right now, going the wrong way, right? It's going the wrong way. That's not going to help. So what does this spell for us? All of this coming together, labor shortages, freight surcharges, energy prices, it's inflation, right? And I couldn't agree more with David earlier today. I was reading reports in the early spring. Oh yeah, inflation's going up, but it's temporary. It's just a COVID thing. No, it really isn't. This is going to be with us for a long time. So these numbers are just staggering, right? These are year-over-year numbers, month to month. 1.2, 1.3, 1.4, and then boom, starting around March, April, and we've just been living it every month. And you see it yourselves. You go to the grocery store, you buy a gallon of milk, and you're like, holy smokes, last week I didn't have to pay this. at the pump, salaries for labor. It's all over. And it's going to be with us for a while. So a lot of pressure on us right now, a lot of pressure. So what can we be doing? We still do have some tax incentives. Again, if you're going to have to pay the piper, at least hear the music, right? So get familiar with those tax incentives. What are you doing right now to take advantage of those tax incentives that are available to you? R&D tax credits, huge, right? That includes process improvement. If you're doing process improvement for your manufacturing line, you can get a tax credit. Take advantage of that. Take advantage of tax incentives that are related to green technologies. That's going to be with us for a long time. So go ahead and grab those tax incentives as you can. Maximize your government subsidies where you can, and reduce potential tariffs with operations located in friendlier jurisdictions. The tariffs are going to be with us a while. You know, for as much grumbling as there was with the Trump administration, I can't believe that we're doing the tariffs. They haven't pulled them. So we're still facing it, and they're even threatening another phase. So don't forget about the tariffs. Be thinking about how you can maybe find ways to relax some of those charges that are happening to you all. So there's a lot to think about. There's a lot going on. We're here to help, of course, right? Cindy, my boss, sitting there, and we've got Michael are here. We would love to answer any questions. I know we're probably a little short on time right now, Tom, but we'll be around, floating around. I'm certainly happy to help take any questions. And we've got Corey McNeely as well. That's our digital transformation expert that can answer questions. So I would love to hear from you. I'd love to, if you can find me, come grab me, have a conversation. I hope that this has been informational. There'll be a copy of these slides with all of the meat on the bone, with the metrics that you can sit down and think about. And let's have a conversation and see what we can do to help. So thank you for your time today. All right.
Thank you, Stephen. Really some great information there. Cindy Hannafy, our consulting leader, is going to introduce our last speaker, Tony Spielberg. So let's welcome up Cindy Hannafy. Thank you.
Hi, everyone. I'm Cindy Hannafy. I'm Managing Director for UHY Consulting and help companies transform. So there's my little commercial. I have the pleasure to introduce Tony Spielberg, our speaker. Now, I got some cheat sheets here because Tony's done a lot of stuff. So he's a visionary leader. He's a strategic advisor with a long history in luxury retail. I didn't run you. And manufacturing operations, and he has been CEO and president of a fast-growing firm here in the St. Louis area. Tony has served on many organizations, on boards of directors, Association of Manufacturing Excellence, and NOM, Manufacturing Leadership Council. Tony has presented a ton of times internationally. And we have the pleasure of having him with us today. He has presented at the Center of Supply Chain Excellence and the Association of Manufacturing Excellence, just to name a few. Now, in his spare time, if this doesn't keep him busy, he's an adjunct professor and on the board with St. Louis University in their business school. Now, I had the privilege of meeting Tony a couple of months ago through a mutual colleague and friend, Jeff Seeney. And when I was introduced, he told me that he was a manufacturing ambassador. And I thought, wow, that's a really cool name for a sales guy. And then he says, I'm not a sales guy. And I was like, oh, okay, well, tell me more. Well, Cambridge has had a long history of operational excellence, a dedication to continuous improvement, and a fostering and positive environment of employee engagement. And they wanted to give back to the manufacturing community. So Tony was dubbed Manufacturing Ambassador. And since he's been with Cambridge, he has visited with over 2,500 unique companies and individuals in the manufacturing industry. And doing so, he's created a synergy, elevated the culture, and engaged the manufacturing community at large. And it is my pleasure to introduce you, Tony Spielberg.
So much. That's a lot of good stuff you had to say there, but depending on my ego, sometimes I'm the ambassador of manufacturing, sometimes I'm manufacturing ambassador. Just depends on the day. I am with Cambridge Air Solutions, and you won't hear us talk a lot about product today because that's not what I'm here to talk about. I'm here to talk about how to move your companies forward in an environment that is difficult. We've heard a lot about supply chain. We've heard a lot about great stuff about strategic planning, especially in the mid-markets and smaller markets. Today I'm going to talk to you about some strategies that we've used, but first I'd like to talk to you a little bit about what my company does and our why.
As I've been in business for quite some time, I've wanted to rally people around something, a cause or reason why we exist.
Cambridge exists
to glorify God by enriching
the quality of every life we touch. I get to tell a lot of people about that, why we exist, and whenever I share, I just share that that's not a faith statement about every single person inside of Cambridge. It's simply an acknowledgement that the business that we call Cambridge is about something much bigger and much grander than just profits.
It kind of knocks people off balance a little bit. They're not really sure what to think of it.
We believe there's something bigger than us, and we're going to conduct ourselves in a way that we're responsible to something bigger than us.
We want you to feel unconditionally loved here, exactly as you are.
If I can be unconditionally loving to those around me and just love them for who they are and not what they're doing for the company, then it can be transformative, and it really does walk out the why.
The glorifying God, why we exist statement was finished by saying how we were going to do that. We were going to glorify God by enriching the quality of every life we touch, whether that's the people that work here, the people that come to call on us to sell us parts for our equipment, or externally when we go out to solve problems for our customer.
And it's something that's a lifetime, it's a journey. And enriching lives, it's not a destination, it's about people.
Enriching lives is about promising to do more than heating a building.
Because it means that anytime you come in contact with the body of Cambridge, your life is going to be better for it.
This is who we are. It's what we strive to do. Do we do it perfectly? Absolutely not. But we always aspire to be better at it.
Really, the culture has been something that means enriching lives all the time. It's just now that we get to write it down and share it with you.
There's something about the Cambridge experience and enriching lives that has been here for many years. We're just saying it the right way.
It's almost like it's just a final piece in a really beautiful process that we've been a part of.
And so I love it. I love the fact that every sticker we put on, every business card we give out, every piece of logoed stuff that I wear or anybody wears is actually going to say, we are Cambridge Air Solutions, and this is what we do. We enrich lives.
I get to work there. It's a great place. We talk about a little bit, when we talk about what we do and why we exist, it does put people off balance. But if you're a manufacturer and you're going to move into this next century of manufacturing, even the next 3 to 5 years, let's talk about strategic planning, you have to be able to look at things maybe with a little bit of that blue ocean strategy from back in the 90s and 2000s when we talked about it. One of the challenges when I was hired, and this is in the middle of COVID, this is October of last year, October 1, was my boss said to me, he said, hey, how do you think we can get 1,000 visitors into Cambridge over this next year? I said, well, there's COVID and we got to wear masks and we're closed to pretty much 90% of our employees. What are we going to do? And I said, okay, let me think about this. So given my background, I had a lot of contacts in manufacturing. I actually grew up in a family where we manufactured ladies' handbags all the way until about 87, and then took everything overseas like a lot of companies did. And during that time, as I was growing up, I was that kid that was 5 years old stuffing handbags at department stores up here in Crowley's. In St. Louis, it was Famous Bar, it was Macy's, it was Stearns. all these places across the country. But what I learned is that the people that made these products were special, and we had to treat them that way. One of the things that we talk about in this challenge was, how do we engage? People are tired of looking at you on screen. So what we said was like, look, let's open up the hood to what we do and just start inviting people in. And look, we'll come see them. It's a simple concept. Let's talk. Let's not ask for anything, let's talk. So meanwhile, we hit 1,000 visitors by March of this year and ended up with 2,557 by September. Why is that important? Well, we went and we said, what are our similar barriers? What are the similar things that we're both struggling with? And what did that turn into? It's turned into hundreds of factory visits, hundreds of people coming to see us, over 2,500 unique visitors that looked at our plant, that wanted to know more about our culture, not just HVAC, which we're really good at making. So when you think about, everybody zigging, maybe it's time to zag, just a little bit. You have to think about doing things a little bit different. Yes, your processes need to change and you need to improve, and we do that with 2-second lean. This actual slide shows our morning meeting. We do these every day, Monday through Friday, 2 shifts a week. People are really, I'd like to say, courageously uncomfortable. A mentor of mine, Mark Braun, had come up with that phrase, but we encourage people to be courageously uncomfortable. Push the boundaries. When you're not comfortable, have somebody next to you. Tell your story. It doesn't matter what it is, but every day we spend a half hour doing this. And you also have to be comfortable cleaning the bathroom. So I'll explain a little bit about that later. So we're here to talk about a lot of things that are going wrong out there, but there is also a lot going right, and how do we help you make things a little bit better? So today I'm hoping that you take a few of these facts away, maybe some new strategies, and if you don't get them today, you can call me or get in touch with UHY, and they can put you in touch with us or some of these other great organizations. So in 2020, it became a punchline, the great toilet paper shortage, right? 2021 is a little bit different, right? It's not just toilet paper. It's eggs, it's tennis balls, it's shoes, it's shoelaces. How many of you in here have a zipper on your body right now? Everybody wears pants, right? What carries a handbag, briefcase? You know how many zipper manufacturers are in the United States? Not enough. Tried to create a whole American handcrafted leather line with Rawlings, and it took me 4 months to source a zipper. It's tough. Now, YKK is actually here in Michigan doing a great job in trying to bring manufacturing back with that industry, but it just goes to show you that we are short everywhere. And what you have to remember is that from a seller standpoint, it's happening from all of their vendors. What can you do to help further that? How can you help further your product even if you don't have it, right? So demand is raging. Salespeople are flipping out essentially, and they're struggling to address the customer needs because all their phone calls are talking about, hey, we have a delay, we have a price increase. You mentioned PMA, amazing organization. Some of the best information in manufacturing is PMA, and I know I don't work for PMA, but I am a member, and I think that there's some great stuff there. So let's kind of move forward. What I'm here to tell you right now is, and I'm going to say this loud, do not take this opportunity to tell your employees to take a break. Do not take your foot off the gas, because there is another company out there that does the same thing you do, maybe a little bit of different DNA, but they're going to take your customers if you don't concentrate and focus on your current customer list. Yes, you need new business, but right now you need to keep what you got and build and see if there's other things that your current customer list can bring you. Sellers, manufacturers that sell into the marketplace. You have to be truthful, you have to be clear, you have to manage customer expectations. When you talk about not being able to deliver, maybe there's another product in your assortment that you can move over. Or maybe you talk to your customers about their total issues that they're having or total opportunities in the next 18 months. Don't talk in the present term all the time. Be clear, be truthful, but also build a plan with your customer and your manufacturer and your end users. Sorry about that. Not a technology, that's for sure. How will you adapt your sales strategy? We've talked about strategic planning. Well, it's all aspects of your company, but you guys all sell something, right? It could be a piece for a car, it could be a zipper for a handbag, It could be anything, and you sell it. So what are you doing to adapt your sales strategy? What are you doing, to the current circumstances? Maybe nothing? Well, that's not the right thing to do, right? Running in place, not the right thing to do. Create promotions around goods that are readily available. And if you can't do that, then you have to incentivize and reward, right? So what's next? What do we do? Are we stuck? Well, let's see. First, you have to communicate and motivate your team. And I've been part of some really great UHY things over the years with Jeff Sini, and I will tell you that they're able to help you with that, but you have to do this on your own. They can give you the structure. You need to take the opportunity and push forward. You need to reset your strategic plan and your engagement strategies. How many of you get 15 emails a day that look like they're personalized, but you know that they're just spraying away, right? Everybody. Is it wrong, right? Make it personal. Serve as a partner to your current customers. Yeah, it's okay to do a Zoom call. And again, I'm going to talk a little bit of blue ocean here because I'm going to zig when they zag. I'm going to go see them. I'm going to do it safely. I'm going to wear my mask. I'm going to listen to all the regulations, fine. But I'm going to go see my customer. I'm going to sit face to face with them and have the tough conversation that hopefully turns into a strategic plan between both of your organizations. Be thoughtful when selling to new customers. Again, you may be the right fit in your mind, but you may not be the right fit in their mind. So make sure that what you have is a match for them. If not, put them on a different list for down the road. Focus on what you have now and people that match up with your DNA. And then, of course, you have to view time as an opportunity. So communicate with and motivate your team. I'm going to put on my glasses. Sorry about this. And if I start to get like Chris Farley, I'm moving around too much, just yell Chris and I'll stop. But, proactive communications. Do not play on fear. The best sales leaders will make sure their teams are well informed and motivated during these times. It's tough to tell when things will go back to normal. So you need to find ways to ensure your sales team has the information and sustained drive that they need to succeed. Proactive communication. Don't play on fear. Do not play on fear. Do not tell your folks that they have to go do this. Work with them to figure out a strategy, right? They're already flipping out their commission checks are less. They're already stressing out that they don't know what to say to their end users. So have that real, truthful conversation, but don't play on their fear. Keep the team incentivized, and then double up on recurring meetings. I know we all feel meetinged out right now, but without that communication with the folks in your organization, it is going to be tough to know where they are and where they stand with you and where they stand with the organization. Bring them great industry knowledge like you're hearing here today. Typically things you don't share with them, but maybe it's time. So again, in talking about resetting your strategic plan and engagement strategies, you have to adjust forecasts. As they say, plan for the worst and prepare for the best. Triage your pipeline. Let's talk about pipeline, right? Because this is going to give you that line of sight where the sales organization should be spending their time the rest of this year and at least the first 3 to 6 months of 2022, right? Because we don't know. There's too much uncertainty. And make sure your team is honest with the process to avoid a misleading narrative, right? Because you can get in there and you can have high hopes and be real excited and, hey, we're going to do this. Is it realistic? Is that reality of the situation? Is that something your sales team can actually really do? And then, staying on the pipeline topic, implement ruthless pipeline efficiency. Expect that fewer quality leads will enter the top of the funnel every month. So it's time to figure out how to get super efficient. And when it comes to your qualified leads, you have to understand your close ratio too. So we talked about data earlier. Make sure you're tracking data here. There's so many great tools right now, and it's become more affordable for all organizations, right? Then curb your sales and marketing expenses. Guys like me don't love that, and yes, I am kind of a sales guy, but not really. Because listen, it's likely not a good idea to have an uptick in spending in these departments, unless your business is in a uniquely thriving department, in an industry. But right now, curb those. It's easy to do, tough to do up front, but it's easy to do long term, and you're setting new habits, right? And you can't forget about these, right? So these, and I know I've got some finance people in the room, so they'd be happy with me. I know my CFO would be talking about this. Have an improved cash collection plan. Why is that important? Your development people, your sales people, your marketing people, they probably are not really ever talked to about the finances, how it works. Why do we have to collect early? Can we incentivize them? Decrease time to value. Work with tech and product teams to simplify product implementation and training. The time it takes to deploy your your solution in customers, they'll see the value, and it should be as short as possible. Let's see, finding alternatives in person, demand generation, all those things that we talk about, you have to do them now. You have to pick up the phone. You can't just spray and pray with these marketing emails. You have to start doing some of those things. But you have to figure out, are there in-person ways for you to do it that you can be comfortable with your company? Again, we're a little bit different as far as manufacturers go, but we are out on the road, and we have been since January, safely. Serve as a partner to your current customers. Your current customers should especially be valued at a premium right now. I talked about it a few seconds ago, but yes, we all want new business. We want to grow our bottom line and our top line and everywhere in between. Where's the best place to do that? Who do you know the best? Who are you most familiar with? Who can you have those easier conversations with? It's your current customer base. Yeah, you're delayed. Yes, it takes 8 to 12 months right now for some production, but this is the best way to start to really partner with your current customer base that are going to have long-term lasting effects once this whole mess is over with. When it comes to current strategies, proactively engage with your customers. Set up time with each of your customers to see how they're doing. Discuss how things have changed in their business. Again, that's a big deal. Prior to the call, have your team do a walk in their shoes. We do this a lot. Every organization that I've been part of, that I've led, somebody taught me this right out of college. Walk in their shoes, right? It's an old saying, but think about that. How often do we do that before we pick up the phone to engage in a customer call or a new potential customer call? Constantly map out the value. Trusted partners stand out from the outside vendors because they consistently prove their value, right? The ROI and usage rates are higher. They are proactive in their communication with their customers, and they bring great ideas to the table for how their product can not only help during the crisis, but how they'll fit in. Let's see. This is a good one, okay? Expect concession requests. Is there a worse thing when you're in a meeting, you've prepared for weeks, you show up at one of your best vendors, and they're saying to you, hey, I need 120 days dating. Or, right, what's the other thing? We've got somebody that's come in a little bit less expensive than you in your product, or your DNA isn't the same as it used to be, or whatever it is, even though it has been. We need a price decrease. Well, expect those. Don't go in standing flat-footed. Expect those. Go into these meetings expecting a concession request, and if you don't have one, hallelujah, right? But that's what's happening in a lot of these manufacturing meetings that we're seeing, and even our sales reps and our regionals that are out on the road are doing that. Encourage sales and customer success collaboration. And why is that expensive? Especially with customers that have been hit hard by COVID. It'll test your technology, right? But what it really does is continue to create goodwill with your current customers. And telling these stories that they can retell to their end users, you have to remember, because if you're a manufacturer, you're selling a good probably to somebody that's selling it to somebody else. So make sure you have a real story. Give them the DNA to talk about. Give them something to stand on other than, hey, we sell heating and cooling units, they have great airflow, and they create a neutral air pressure. Like, what's that mean? Give them the stories. Tell them who you work with. Is it their competitor? Is it impressive that that you sell to, most of the customers you sell to have less than 100 people in their manufacturing plants, and you've created the opportunity to have less turnover because it's not 100 degrees in their factory, right? It's 78 degrees where they're most productive because they put an air conditioner on the roof or another airflow opportunity, whatever it is. You have to be able to tell the story. Go back to the storytelling. Go back to the days that you actually were excited about your product. The same product that you may have made making for 100 years or 1 year or something that's brand new. But you have to make sure that the DNA is understood because people flow through organizations, they change roles, and it's not always understood what you do. Yes, and finally on this stuff, you just have to drive expansion. You can drive expansion in new product or education opportunities. And I have with caution actually up here because when you're talking about driving new opportunities and new product opportunities, especially in a time like this where there's panic and there's uncertainty in your organization, if you launch a product and you're not ready for it, what will happen? You'll fail eventually, right? You have to have a strategic plan. You have to engage with advisors that will help you get there. You cannot be the master of all. We all have an ego, but we all have to remember that we are not that we are not those people. You know, and this is something that I've been talking a lot about lately because it's something that we are experiencing in manufacturing. Most people are extra sensitive to being sold to during uncertainty. So many things out there are contributing to this maybe inauthentic atmosphere that we have. Everything that when you get talked to all the time, you get millions of emails, hundreds of emails, I should say millions, hundreds of emails during a week that says their product is the best because they have a spray and pray method of marketing to get that to you. It doesn't work that way. Make sure that you're authentic. Pick up the phone. Don't just email. Pick up the phone. Talk to these customers. The current climate's going to require new business development professionals to exhibit more creativity and thoughtfulness on how they engage with prospective customers. That's the bottom line. So we're going to talk about 5 pretty simple things to do. Okay? 1, be thoughtful and empathetic. It's difficult to gauge the personal and mental and professional issues your prospects are managing. Remember, they too are like you guys. They are experiencing everything in the outside world that they didn't just 2 years ago, right? Make sure to exhibit personalization and empathy in your outreach, and once you properly address your care and concern, make sure to honor the prospect's time by being concise and helpful in the conversation. Goes back so far back. Have your elevator pitch perfected, but make sure it's personalized, right? Don't keep these people longer. If you engage them in a Zoom call, it's a half hour. Don't say 33 minutes. Set the contract up front. Keep the contract. Build your authenticity for this people that you're dealing with, which are your most important people, which are your customers. 2, determine if you're essential versus non-essential for their business. I mentioned this a couple minutes ago. You know, if your product is absolutely mission critical to a prospect's business operation at that moment, it's okay to carry out your full-blown plan or attack, right? To win. But just be mindful, if you're a nice-to-have product for their business right now, take an educational and thought leadership approach with your sales strategy so you can build awareness and credibility. Different funnel. You have an immediate funnel, right, that's ready to be qualified and go down. Then you have a longer-term funnel right now, and we've all had those before, but we haven't really thought of them that way. So, 3, qualify prospects up front. So many of our companies pay so much money to put our people through Sandler and all these amazing training programs, right? Make sure that we're qualifying prospects. When you qualify a prospect and you hand them on to the BD person or the internal salesperson or the actual regionals or whoever it is, give them something good to work with so you maintain your authentic ability to work within your own company on this. You know, we've seen some enterprise tech leaders taking more discovery meetings to learn about new solutions. It's fantastic, but you got to make sure the team qualifies their realistic buying timelines. And really, you'll know if a C-level person is window shopping, right? We all know those things. 4th, make sure, again, get it up there. There we go. Make use of storytelling and case studies. Focus on telling your story. Showing relevant case studies will drastically reduce the time for your team to earn the needed trust to advance your sales cycle. Pretty easy stuff here, right? But a lot of it is tried and true. A lot of it we've just kind of skipped because there's so much automation. We have to get back to some of the basics and treating our customers like customers that are partners. 5, have an enhanced objection handling game plan. Why is that important? Well, we always talk about barriers when we go into meetings. You go into a meeting now, and you have your literally maybe a 30-second Zoom call or your 30-minute in person, or 30-minute Zoom call. You've got to get your point across a different way. You've got to be ready for their objections because you don't want to spend 75% of your time talking about that and why your product is better, right? We're cutting across the basic things where you're cutting costs across the company. We're no longer evaluating any new solutions. Have a pre-crafted response. Again, I know I'm talking to a more of a C-level audience today, but these are things that really need to be pushed throughout the organization. So you have to view time as an opportunity, right? You likely have more time since your in-person visits have been curbed for some companies. Again, we've taken an opposite way. We do in person, we're also doing virtual. Put together a list of all the strategic sales executives, excuse me if I could talk today. Put together a list of all the strategic sales objectives, right? You and your team are always they've intended to do, but keep pushing off. This is the time to do it. You've got time right now, right? Be prepared to use that time to your advantage. Fix what bugs you. So Fix What Bugs You comes from an author, Paul Akers, who wrote a book called 2-Second Lean. I'm not sure if any of you are familiar with 2-Second Lean. It's essentially a different way of doing lean in manufacturing. We've adopted it at Cambridge, and before I was at Cambridge, I stole it from Cambridge and put it to use at Boone Center, which is where I ran a company. And essentially, you take processes, you shorten them up, you see a problem, you videotape the problem, or you take your phone, and then you show the rest of the company what you found that bugs you, and you fix it, right? So fix inefficient internal processes, update collateral and messaging, right? Has your team been using the same sales deck for the last few years? Simple. Let's move that forward, right? Implement internal think tanks. Implement ways for the whole team, not just sales and marketing, to strategize and share ideas. It's important to be inclusive here, and this is inclusive in a different way. Tighten up your data hygiene. Bad data eventually becomes a huge liability, and it's a good time to re-educate the team on CRM data, the CRM data gold standard, right? And one more. Take this time to improve your team's skill set. It is the perfect time to get back to your team, understand where their top weaknesses or areas of improvement that are holding them back, right? Let's get them to be more effective in their role and during this new environment. It makes pretty much sense. What I'm saying here is not gold. It's not anything that I've made up or can write a book about. These are things that we are seeing out there that need to be done to keep your company moving forward and be part of your strategic plan. Support your teams in finding ways to make improvements in this area. If you do have some time, Paul Akers' book is free. It's online. There's an audio book. Literally, it changes the way you think about everything you go through life, and you're making changes 2 seconds at a time. It does not have to be a long, drawn-out process. So I want to bring this back a little bit. Usually when I'm up on stage, I'm talking about culture and manufacturing, tearing down the walls between the front of the house and the back of the house, and what's going on. And I wanted to share some of the things that we have done team building wise at Cambridge, right? So what we did was we actually called in Dale Carnegie, tried and true, right? We trained all 150 employees on how to improve communication and empathy in all situations. How many of your companies have said, hey, we're actually giving our employees the power to be able to communicate, be able to know how to communicate, to get all these tools that we all learned in college and then, or along the way? Not a lot. It's funny, I forgot that Zingerman's was in here today because I love the deli when I come up here, but Zingerman's actually has this awesome thing called Zing Train. And Zing Train absolutely helped us build our vision, and not just us, our entire company. We offered it to all 160 employees. I believe that we had 122, I could be wrong by a few numbers, but 122 employees, including our forklift drivers, our CEO, folks that are maintenance, everybody that wanted to take place in visioning got to understand how to build a vision. This was not cheap, however, it was very effective, and now people feel like they are part of our process. The other good thing that we do is we work to create job matrices for clarity around career advancement. A lot of folks don't do that. We have an employment program called Unleashers, and I'm not here to talk about that today, but if somebody comes in and they're not the right fit, we absolutely help them find another job that is a better fit. It might be at another manufacturer, it might help them be career exploration, but not in the way where you just pay for a service and they go. We actually internally help these folks. We sit down with them and we say, look, you're not a great fit at Cambridge. Let's help you find something so that you can be happy in the rest of your life and what you do. Something to remember while your strategy is being reimagined, you're retraining the sales team and development teams and marketing teams and executive teams' muscle memory. So there's going to be a period of transition until new habits are fully formed. they're not working right away, give it a little bit more time. This is all new to a lot of folks, almost everybody. Then I want to talk about finding, every business development leader should consider the following, right? Find a financial partner, establish a sound funnel, manage, really manage your tactics and how you build your funnel. The financial partner, obviously we're being hosted by one of the best ones in the world today. They do all these things. All you have to do is ask, right? Maybe write a little check. But other than that, candidly, UHY is one of the best at this. I'm not here to talk for UHY. I'm just here, but we've worked with them in many companies that I've been with, and whenever we have that issue, if they don't know, they have an expert to turn you to, which is really nice. Determine the vital few key metrics to focus on. Often, these are quarterly gross bookings, net retention, gross margin, exit monthly recurring revenue. Align on goals. As the head of business development or head of sales or head of company, ensure your goals as both an executive team member and a sales leader are aligned. Your personal goals and the needs of organization must be balanced. Right? So we talked about creating an accountability today internally as a sales organization, as a manufacturing organization. We've talked about a little bit about, make sure your funnel is right, make sure that you have processes in place. You have absolutely the time right now to do these things. Reimagine what you're going to look like. Be courageously uncomfortable. If you can live in the state of courageously uncomfortable, you will be ready for anything going forward. Some other takeaways and some things that, we're seeing trend-wise in manufacturing. Do I have time? Yeah. Some other things that, that we're seeing, when you talk about labor shortages and some things that companies are doing in manufacturing, they are targeting the one group that has never been targeted before in manufacturing. That's women. I had the opportunity last week to be in Salt Lake City, and there was a manufacturer called Bullfrog Spas. Maybe some of you are fortunate enough to have one of those in your backyard. 40% of their manufacturing workforce, which I'm guessing is a total of 600 people, were women. Once they got that number, I was told once they got that number over to 30%, their process or their efficiency and process improvement and total output of spas increased by 14%. Maybe it's just happenstance. Look at other opportunities to build your workforce, right? Cindy's laughing at me, but honestly, we're seeing that, when we're looking for opportunities to rebuild your workforce, and your marketing department is taking the same issues. We're going to go to vocational training schools. We're going to advertise on whatever job website it is. Make sure your target's right? And it's okay. It can look different. It needs to look different. It's been the same for as many years as you've probably been in business. Other than that, how else can you prospect new customers? Because we didn't talk about new customers. One of the things that, as the manufacturing ambassador that I do, is I work with manufacturing associations all over the country. Missouri, what I learned from Missouri, that's where I'm from. And I know that this is a national audience, but in Missouri we have 6,300 manufacturers. 6,000 of them are less than 100 employees, and 5,600 of those are less than 50 employees. Think about how you're approaching the people that you deal with. If you go in with this full-blown thing because they're 60 million in volume, they may only have 42 employees, right? You don't know. Make sure you're doing your homework there. That's a big deal when you're talking to manufacturers. Manufacturing organizations can be a wealth of information, a great way to connect, but you have to put in the work. I don't work with the Manufacturing Association here in Michigan, but we do work with them all over the country. In Salt Lake City, I just was there last week, so I'm familiar with it. They are working on helping create this inland port. Why is that important right now? It's on slides, right? Supply chain is tough. We can't even get the boats to shore. Well, let's give them another option. Can we fly directly into Utah, which is not the middle of the country, but further in, right? No unions, not there's anything wrong with it, but they are setting this up to be successful right away, and as they build, other states will follow. But why not? The Port of Savannah, great example, right? It's full right now. However, there are places like that that are popping up that you need to be familiar with and you need to figure out how. One of the best ways to do this is join your local manufacturing association. Again, not no skin in the game for me, but we are learning more from the independent associations across the country. National Association of Manufacturers is a good one. But again, I think you have to be able to take the way that you're prospecting now and think of other ways to connect. Not just people are not just meeting to network anymore. You have to go make it count, and attending maybe one of these associations will definitely help. But other than that, I think that to summarize everything that we do as a company, because a lot of what we talk about at Cambridge is culture. If you don't fix your own culture, if you don't tear down that wall between the front of the house and the back of the house, the back of the house and the front of the house, you are going to keep losing employees, right? Great information on that earlier. Fix what's broken, do it now, be inclusive of your entire organization, and let them be part of the visioning. Let them be part of the strategy. It doesn't have to be final decision, but if you don't fix that culture, it's not going to work. Everybody's unsure, right? Half of them were laid off. Now they're back. How do you make them feel like part of the team, that they're part of a sustained opportunity going forward? So if you are interested in culture, we welcome in, again, over 2,500 guests over the last year. We do a stand-up every morning at Cambridge. Our stand-up meeting is 30 minutes, as I talked about earlier. And then we do lean and clean. So it's a total of 45 that we're not doing production during that time. We're allowing people to use their employee genius, and we're allowing them to fix what bugs them, right? And then share that with the entire organization. Promote culture in your organization. And if you have questions or if you have thoughts on it or questions about it, reach out. We share with everybody. This manufactured ambassador title is weird. People are like, what do you do? Like, what does that mean? First of all, I get to go talk to hundreds of manufacturers a year without any revenue assigned to me. Well, some of you owners here are like, what? We're not having anybody that pay them this money and they just go out and talk. What it's doing is it's building relationships. It's talking to our competitors, right? Cambridge, we're a $40 million HVAC company. Trane is billions. But we were on the phone with the CEO of Trane about 4 months ago talking about what are current and common barriers, not proprietary information. You have to reimagine how you do things, and you have to start to move forward and think about your business as an industry, not just your own business. Collaborate with your competitors. It's fine. It's okay. There's so many good examples of it out there. But at the end of the day, that's going to help with culture. It's going to help with leadership. Might even find some good employees as you're collaborating with your competitors, right? It's tough right now. So please come see us. We'll come see you if you're comfortable with it. Please connect and ask any questions. And we share everything as a company. We also share it with the outside world, even most of our financials, I would tell you. So if you're interested in learning more about processes and our process improvement and 2-second lean and culture, please come visit us at Cambridge Air. Again, I wanted to thank Tom, Cindy, and I have to give a big shout out to Jeff Sini, who I've known for years and has the best network list I've ever seen. But again, thank you all for having me today. Hope that you were able to have a few takeaways, and please connect if I can do anything for you. Thank you.
Thank you, Tom.
Well, we made it through the rainstorm and all. But thank you for everyone that's online that joined us. I don't know that did we solve all the world's problems in 4 hours? I think it was close, so we got most of them, right? But I hope there's some really valuable information there. Obviously, reach out to us. This is our manufacturing outlooks are really around, thought leadership and having a little bit of vision, a little bit of crystal ball to pull you out of your business for a few hours and think about, really strategy and some bigger picture stuff. We think there's tremendous opportunities out there. I know it doesn't feel like it today because we're enduring, a lot of issues as we discussed today. But there are a lot of solutions, and we have to work on a way to grow. The best way to fix a lot of these things is growth. We have to put together a growth strategy. I want to thank all of our presenters. Thank you. Thank you, Cindy, our consulting team, for joining us from Atlanta. And finally, I want to thank all of our geos, our marketing team here in Michigan and New York and St. Louis and Atlanta. Thank you so much for all your help for making this a great success. And thank you for joining us.